check out the equity market, equity futures so far this morning, and good morning to all of you stateside just waking up. Equity futures on the S&P 500 doing okay. We're down just 0.2%, no drama there. Had a decent run over the past few days. Over in Europe, we've seen a really, really big run. Record high after record high in the last 24 hours or so. In the bond market, you're just starting to creep higher again, Lisa, up by 3 basis points, the 10-year. 464.
Yeah, and this comes after actually rallying. And there was a question here, and Ron Khrushchevsky, excuse me, of Stifel was talking about how maybe there's a lot of optimism baked in, that maybe there won't be some sort of extension of debt and deficits, but still a big sort of uncertainty hanging around that space.
The data point of the morning is not jobless claims at 8:30 Eastern time. The data point of today comes a little bit later on when we get the address from the President of the United States, Donald Trump, into the World Economic Forum here in Davos, Switzerland. We've all been whipsawed by trade headline after trade headline, but there is a feeling, essentially, so that maybe you don't take those headlines too seriously. At least that's the way the equity market and foreign exchange has behaved at times.
Which is the reason why so many people are looking at not just the words that President Trump says, but the fact that he is addressing Davos, that he finds that important to do, and exactly how he characterizes his relationship with the rest of the world, when the rest of the world certainly is listening.
We're going to have a big conversation about financial markets in a moment, but we have to start with something much more important. TCW CEO Katie Koch joins us now for more. Katie, it's good to see you.
Good to see you both. Thank you so much for having me here.
Thanks for being here. Super strong ties to Los Angeles. Let's start there. It's important. How bad have things been? Give us an update.
Well, thank you for asking about that. TCW is a global asset manager headquartered in Los Angeles. We have 480 families that are based in LA County, and it's been really difficult. We have 5 families who have been permanently displaced. I've been talking to other CEOs here. Many of them have been impacted by this as well. My family has been permanently displaced, and it is tough. And I would say what I want to kind of focus on here is the fact that the community has really come together. I'm so proud of the way the TCW people have come together to support each other and work through this, and I know other CEOs feel the same way. And for me, it is personal. While we did lose all of our things, the thing that we're really grieving as a family, and it's different for every family, we're very fortunate we had insurance. So thank you, Goldman Sachs, ACO, Pure Insurance, and our broker, Willis Towers Watson, we can replace. We're very fortunate. But what we're really grieving now is the Pacific Palisades community where we lived. And you guys know my family pretty well. I had the great privilege of working at Goldman for 20 years, had the opportunity to move to LA to work with TCW. I took that opportunity, but I had to bring the 4 kids and the husband across the country, and you would know this. I feel guilty about that because I'm pursuing my ambition. My family has to come along, and we get to the Pacific Palisades, and we just felt at home. The people are extraordinary. They've educated my kids, coached my kids, opened their homes to my children. And one thing as a working parent you guys would appreciate is that I can't be there for every moment of my kid's life. I can't do this job and be there. Yeah. And there were so many times where I was traveling and I would see a picture of my kids at the chapel or at drop-off or pickup because those parents in that school did that for me and sent those pictures, and I'd wake up. And that's my special connection to the community. There's thousands of people across Los Angeles that have their own special connections. And so we have to rebuild. We have to rebuild because it's economically important. Los Angeles, the GDP of Los Angeles County is bigger than Switzerland, so it's economically important. And because we need to, we have to reestablish these communities. And I'll just end by saying, I am a believer that when things are difficult and people come together, you're able to tap into resilience and courage in an extraordinary way. And I think that's what everybody's going to see from Los Angeles in the coming years.
Well, I've said this on your behalf. You're one heck of a resilient person.
Thank you.
Lisa, we've talked about this, the scale of the devastation. When you compare it to the nation of Switzerland and the Swiss economy, I still don't think many people outside the United States understand what's taken place in Los Angeles over the past few weeks.
Yeah, devastation at a time where there still are active fires and there's a real question of getting under control, but also opening up larger conversations about how to rebuild and how to rebuild smarter at a time when this is an issue that will continue being a problem going forward. I mean, this is really clearly not something that can just sort of be forgotten.
Yep, that's right. And I'm highly optimistic we're going to come together, we're going to tackle it, we're going to use ingenuity and a shared love for each other in Los Angeles to rebuild. I'm very proud to be here representing TCW. Well, also looking forward to getting home to see those kids.
I have no doubt about that. I have no doubt about that.
By the way, I learned something new about John.
What's
today.
that?
His mom watches this show for a half hour every day to connect with him.
Just 30 minutes.
30 minutes?
So she feels like I'm still there.
I love that.
I love that too.
Fan. I hope she's watching right now.
I hope she is too. If not, I'll clip this for her. You've been generous with your time.
Yeah.
We'd love to talk to you about financial markets as well, if we can.
Yeah, of course.
Let's talk about the US economy and the word that you mentioned just a moment ago, optimism.
Yeah.
There's a lot of optimism around Davos, Switzerland, but a note of caution from you about how fully priced that might be in financial markets. Give us some color on that if you can.
Sure. So that is the mood. I've been watching some of the people, you guys have been doing a great job covering this, that you've interviewed. And so the dominant mood is extreme optimism, executives especially. What we're hearing is that this is going to be a very pro-business moment for America. Animal spirits are going to keep going. M&A cycle, obviously part of that being reignited. And what I was saying to John earlier is that, I think that's all possible, but we're in the money management business. We have to actually create returns for our clients. And so for us, it's what's priced in, and the market's already priced like this. So a lot of that optimism is priced into the markets. And this idea of U.S. exceptionalism, just to put that into context for people, just factually, the U.S. has demonstrated exceptionalism. We're 4% of the world's population. We're 20% of GDP. We're 68% of global equity market capitalization. So that's factual. The question that we need to push ourselves on is it sustainable and how much further can it go?
Do you think that bonds are overly optimistic or stocks?
Yeah.
Both? Which is more optimistic?
It's very scary when bonds are overly optimistic, but if you look at credit spreads now, just let's focus on the U.S. if I could for a second. So as you guys know, we manage $200 billion globally. We are a lot in the credit markets, private and public, as well as public equity. And when we look at our credit, when we think about fixed income markets in the U.S., we do think the credit markets are expensive, and we are underweight credit in some of our portfolios. And it is a negatively convex trade, and what I mean by that is that we are taking that underweight position, which means we're carrying under some of our peers and indexes in our kind of core plus portfolio. But that gives us liquidity and optionality to take advantage when there is a dislocation and step in when other people can or won't.
Do you think that there will be a dislocation? Do you expect that there will be some sort of inflationary shock that will cause people to realize that maybe things are too optimistic?
So I don't get to see that many panels here, but yesterday I was in between events and I watched a panel, and I'm not going to name the person, so don't ask me. I'm telling you that up front. But someone made the comment that that we didn't need to worry about the business cycle because the business cycle's over because it's being superseded by all these mega trends. And it made the hairs like the back of my neck stick up like, oh my gosh. So my answer to you is, of course, something's going to happen. Like, that's how the world works. And our job is to navigate that for clients, to maintain liquidity, again, so we can step up and provide it when other people can or won't, and to take advantage of the volatility. But for active management, actually a volatile environment can be okay. And I feel really confident about our ability to navigate that for clients.
Well, you were on a panel earlier this morning with me, and you mentioned the deficit. You talked about that being possibly a big risk and the potential, and you can give us the likelihood of a failed auction. Understanding that moment. What does that moment look like, that day of reckoning where we understand maybe we've pushed this a little bit too far?
Well, just taking a step back, when you ask the question, like, what could go wrong here? We are running a large current account deficit, defined as peacetime periods, effectively, 6-7% as a percentage of GDP. That's called an economic miracle in the United States. It's a fiscal crisis in France, where they were doing the same thing. Why can we do that? Because we have the exorbitant privilege of being the world's reserve currency. My comment to you is that this could go on for a long time. Like, we don't know what the catalyst is that's going to make people focus on that, but I would absolutely put it on the list of things that could go wrong, and we need to get it under control. And there's been a commitment from our future, I think, Treasury Secretary, that we would try and bring that down to 3%. I just don't know what the solution is for that yet, because the only way you can really get there, it's not going to be DOGE, although I wish them the best of luck to run the government more efficiently, but it's going to have to be something around entitlements, and I'm not sure that we have the political will to tackle that now. But to answer, that could be the thing. It might be something else.
Katie, I said it earlier. You're the best. Appreciate your time.
Oh, thank you so much for having me.
And our thoughts are with you and your family too, and the whole community.
I appreciate it. Stay strong, LA.
Thank you so much.
Thank you.
Katie Costa, TCW CEO.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Equities down about 0.1% on the S&P 500 with 2 hours until the opening bell. Just had a wonderful conversation with Katie Koch at TCW, just on the risks out there. That yes, things are good. Sure, they could get better. But in a lot of places, that's fully valued. And the number one issue for her potentially is what happens with the fiscal deficit. And Lisa, I know that is your favorite topic.
Well, absolutely, because we have to focus on the auctions every time they come out. And there was a 20-year auction yesterday. It went okay. But there is this concern. And you're not seeing it really expressed in bond markets, which have actually gotten calmer as we've seen President Trump in his third day in office. Will that change? And that really remains to be seen.
We will hear from the president a little bit later on this afternoon. So look out for that. We're 2 hours until the cash open. Let's get you some morning movers. We can do that with Manus Cranny. Hey, Manus.
Jonathan, good morning. This is a company led by Larry Culp. It's their first year, as he said, of standalone, and it was a monumental close to the year for them at GE. They're going to raise the dividend and the buyback. The dividend up by 30%, the buyback $7 billion, and the free cash flow SCF is critically important, just under $7 billion, way ahead of the estimates. So this is about standalone. They divested the power, they divested the health assets. This is a pure play on aerospace. Yeah, they've got supply chain issues, but they're working through those. What a different story for American Airlines, down 8%. Just think 24 hours ago we were talking about United, premium cabin, transatlantic route. Here you've got an unexpected loss to come in this first quarter. Yeah, they've got record free cash flow, but this is about breaking away from their bullish rivals. They've got capacity constraints. That's reducing their CapEx. Okay, so your CapEx is down, but you've got capacity constraint, which really holds you back in terms of what you can actually deliver. Down over 8% at the moment. An unexpected quarterly loss of between 20 to 40 cents in the first quarter. That's on an adjusted basis. Rounded out, entertainment software. I'm not a big player of these games, but there are monumental appetite for this. Apex, Sims, UFC, football games, etc. The guidance here is on their net bookings. It's lower than the market had expected. $7 to $7.8 billion. Just think of some of the names. Global football ending down mid-single digit. This is about peak game interaction, peak numbers in that, and Dragon Age, 1.5 million players. That's down 50%. So the question you're asking is, what does the peak look like in some of the proposition they've got out there in the market? Jonathan, Lisa, good morning.
Manus Cranny, good morning to you, sir. We'll catch up with you in about 60 minutes. Manus mentioned sports. Do you notice that?
Yeah, the sport.
Good. Steve Paliuka sat down with us and Lisa leans in and goes, apart from sport.
Okay, all right, okay. Oh, hold on a second. But you've been talking about Atalanta for like about 3 years now, and you're so excited. And I know that the whole thing is going to be about Atalanta and Celtics. And honestly, and I think that that's wonderful. But he's got a lot of tentacles in a lot of places. Really, you're going to do this on there?
Capital Private Equity Senior Advisor joins us now.
Let's rewind.
Steve, hello. Good to see you.
Great to be here.
Let's start with sports. Well, you went to the game on Tuesday night.
I thought it was an ESPN.
We went to the game on Tuesday night because Atalanta 5-0. What a story for that team this year.
You know, I'm still pinching myself. It's just incredible. I'm very happy for the team and the coach and the Procassi family. It's been great for Bergamo and Milan, and it's just really exciting.
I don't want you to get too excited, but can you win the league this year?
You know, the old adage, take it one game at a time. So we just got to get healthy. We got a couple guys that are hurt, but they're playing fantastic.
It's amazing to see. Barcelona up next, and maybe straight qualification to not the next round, but the one after that, right?
Yes,
that's how it works.
Be big. That would be big.
Big for European
football. I'm hoping to go to Barcelona.
That's the football. Okay. Can I do the basketball?
You should do basketball. Okay. Actually, there's a lot to talk about.
I can do the basketball.
Yeah, let's do basketball.
So reports that you're after majority ownership of the Boston Celtics. How much can you tell us this morning?
I can't comment, as you know, on any deals, including that deal.
Okay, that one specifically. Can we talk more broadly about the NBA franchises and what's happening there? Because I have noticed that audience levels, TV audience levels, have fallen off in some parts. What do you think is behind that?
You know, I think it's fragmentation of viewing, and I think the viewership's really good when they can count it correctly and really find out who's watching where. So I don't think there's a concern there, and the league is really strong and has more stars than ever, and you know, it's been fantastic. So I think that's kind of a bump in the road.
So we've covered football, we've covered basketball. Any other sports that you're going to buy a team in?
No, I'm not into cricket, so I'm good.
Well, I mean, there's golf.
You can do business now. Okay, you can move on.
No, I mean, honestly, there's actually a lot to talk about and whether you're going to buy another team. Are you going to buy another team?
Who knows?
Okay, all right. Well, let's move on, because right now we talk about Davos, and it all has been dominated by incredible optimism. America is going to boom, and Donald Trump, what's he going to do? Of course, there's also the overlay of artificial intelligence. What's been your biggest takeaway about what people are concerned about with the Trump administration?
Well, I think, first of all, this Davos is all Trump, all AI. I mean, that's all people are talking about. And the Trump issue is, you know, what's going to happen with tariffs. You know, Europe's worried about tariffs. Everybody's worried about tariffs. What's going to happen with the Ukraine? What's going to happen with the American economy and protectionism? That's their worry. And on AI, you know, AI is for real. It feels a little bit like, you remember 1999 internet boom. So there's a lot of hype, but there's a lot of reality in AI, and AI is going to change everything. I view AI as almost like building the railroads and the interstate highway system in the U.S. We're going to need to have that over the next 20 years, or we're going to fall behind. So I think it's a legitimate discussion on AI, and they came out with the Stargate program, which I think is fantastic, because other countries are getting ahead. China's investing billions, UAE is investing billions, Saudi's investing billions. I think the U.S. has to get out ahead of that trend, and it's going to affect everything over the next 20 years. I'm really excited about it.
As an investor, what's your approach to all of this? How do you think about the opportunities? You mentioned the late 90s. It took a while to find out who the ultimate winners would be. Are you expecting something similar this time around?
It's going to be a little different because I look at AI. You had winners like Google that were kind of natural monopolies. There can be many variants of large language models. So there can be a global large language model. There can be probably 4 or 5 of those. But now the real use is going to be vertical ones. So tailoring models with the data, specific data for, say healthcare. Specific models for transportation with transportation data in it. So I think vertical AI models will be the ones that start to impact the economy. And then the other ones are going to grow, and we need that infrastructure. And then what's going to happen is from that, you need power. Fusion is being talked about and is around the corner. All the fusion companies I look at are getting close to actually generating energy. The models are showing soon they're going to generate energy and build these large tokamaks. That's going to have to power all the centers to get us the GPUs. Because if you look at the power uses of AI, it could be the entire power right now in the United States. So I think this Stargate program or a program like it is needed, and we've got to match those other countries. And that is going to create a virtuous loop of spending, building the infrastructure, and it'll be great for America. It'll revolutionize healthcare as well.
I know that you've been very active in that space in particular, particularly in the speed that it will take to put new prescription drugs on the market using different machine learning techniques. I'm just wondering, is that your main focus right now of investment when it comes to AI, or are there other regions that you think are promising in the application in the near term, not just these long-term goals?
Well, I'm focused on the healthcare because I think that's the number one, but it'll be helpful in energy and finding energy and processing energy. It'll be helpful in transportation. It'll be helpful. It's going to be embedded in every business. And I think like liquid AI, which we're invested in, that doesn't require, it's built, as we talked about last year, they studied a worm's brain at MIT. Like, who would do that? There's 300 neurons in a worm's brain.
I think it sounds fascinating.
How many neurons do you think is in your brain?
301. No, I'm just kidding.
The average person has 86 billion. You guys probably have 87 each, but 86 billion.
Thank you.
You can come on again.
But they've come out with an AI system that requires 80% less power to load it. And that means you can put it on an edge device, so it'll be on your phone. So you're going to have, your assistant on your phone. This is going to start to be on all the phones. It's going to kind of revolutionize the way our lives are.
One aspect of this Davos that's so interesting is that there's some real tensions that need to be resolved, especially as everyone's talking about artificial intelligence. On the flip side, Donald Trump talking about national security. He's talking about the chips in the U.S. that could potentially transmit data back to China or one of our other adversaries or competitors. And I'm just wondering, as an investor, how you understand what's national security and what isn't.
Well, it's difficult. You got to follow the government, and it changes all the time. I think in general we do need national security, but it has to be focused. It has to have a purpose, and hopefully they'll have rational people that decide, what that is.
Do you worry that some voices will get a bigger say in the future in the private sector?
No, I don't worry, because we have a system that I think will work in the long term, and there's going to be a lot of there always has been fighting of different companies for different things, and so we'll get through it, and hopefully we'll do the right thing. We've got a Congress, we've got the court system.
Sure.
The United States is very stable, so I do think we need cybersecurity, and we need security in general. Hopefully we can have a détente with China, so we don't have that going on. And I think Trump wants to cut deals, to move the economy forward, and I think that'll be a good thing.
I'm sure a lot of Europeans have asked you on your opinion on what the next 4 years is going to look like. What have you told the Europeans when you're asked that question?
I think the next 4 years, the Europeans, I've been to many meetings here with health ministers and all sorts of ministers, and what they say is the EU really isn't a full union. They use the same money, but there's not an integrated capital market. There's not integrated anything in terms of starting a business. You need to fill out, 100 pages of forms in Germany and different ones in Portugal. So many of them talk to me and say they need to create a 28th state with a set of rules, a virtual state with one set of rules to start a business and one set of bankruptcy. Bankruptcy is different in every country. You can't have a great capital market if you're dealing with 27 different bankruptcy codes or 27 different ways of doing things. So I think it's a great idea to start a 28th virtual European state, and businesses can opt to be in that or be in one of the 27, but it's hard to be in both of those at the same time. So the big advantage the U.S. has is it is one market, has one set of regulations. So we have a leg up, and hopefully we'll make that even better in the next 4 years.
I want to return to where we began, which is sports, and my sport, which is auctions. I'm looking at bond auctions, which I think is like a sport right now.
That's quite a term.
Well, no, hold on a second. No, I'm serious, because I wonder how much you're watching what so many people here are worried about, which is that all of this optimism, all of this, happy talk about getting together and really focusing on growth could get really stymied if you start to see bond yields climb and you start to see the fiscal pressures really come into play. How concerned are you about that?
I'm very concerned. All the data would show when you have an increase in the money supply as big as it's been in the last 5 years and a large deficit, that's going to cause higher interest rates and inflation. Those kind of go hand in hand. So my biggest worry is inflation going to get out of control and keep those interest rates up there? I think house mortgages are costing 7%. We definitely have to increase the supply, and they're looking at programs to do that. But with 7% mortgages, that's not great for growth.
You mentioned 1999, and we all know what happened after 1999. And there is this feeling that there needs to be a washout in some of the startup companies as they deal with technology that continues to evolve. Is that the big concern, that this kind of increase in rates could really catalyze that kind of washout? Is that what you're keeping your eye on?
Yeah, increase in rates definitely catalyzes washouts, because when money is free, there are no washouts, right? We had free money for a long period of time. Now, the good news is, for most of my life, too long life, most of my life, interest rates have been, T-bills have been 5%, 5.5%. So it's not anomalous. But yeah, that is the fear. We've already seen a lot of the companies' valuations go down and get wiped out. So I think we're kind of through that. I think that there is a lot of hype on AI, and there's probably some fundings at very high levels, but I don't see it like it was in '99, where everything across the board was crazy. I used to walk into a room in San Francisco. They give me a term sheet and they say, we have a company that's going to, internet company is going to reduce the supply chain cost of medical equipment. We're valuing the company at $100 million. It has no revenues. This is the idea. And you have 2 hours to decide, do you want to invest $10 million at $100 million valuation?
I'll pass.
I was fell out of my chair. I mean, this is a real story. I said, thank you very much. And 999 of those went bankrupt, and then we had Google and a few other ones that did well. That's not the situation we're in right now.
Steve, you're a gent. It's good to see you.
Great to see you.
And good luck to all your sports teams.
Forza Atalanta, as we say. Forza
Without a doubt. Without a doubt. Steve Pagliuca there of Bain Capital and Forza Milan too. You know, we've got to squeeze that in as well. Can't be all Atalanta every day.
Well, he does.
You know?
He's going to be the stink eye.
Should have bought that club. Well, anyway.
Just letting you know.
Auction of sports. We're doing viewing parties at 1 p.m. Eastern time every time we get an auction.
I think that would be really fun.
Well, we have a brand new renovated stadium, so they're all coming there. Milan is in a very old stadium.
So you're going to host the viewing parties for bond auctions? Yes. Okay. In the Atalanta
Stadium. Just threw shade at San Siro. Anyway, let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Away from sports, President Donald Trump downplayed the national security risk posed by TikTok. Trump sat down with Sean Hannity of Fox News for his first TV interview since taking office for a second time.
We have our telephones made in China for the most part. We have so many things made in China, so why don't they mention that, you know?
Let me get to
the
some
interesting
issues.
thing with TikTok, though, is you're dealing with a lot of young people, so
they love it.
Is it that important for China to be spying on young people, on young kids watching crazy videos and things?
On his first day in office, Trump signed an executive order delaying the app's ban by 75 days. This week, Trump floated the idea of U.S. buyers like Elon Musk or Oracle's Larry Ellison with a stake from the U.S. government. Ukraine's President Volodymyr Zelensky says that any effective peacekeeping force in Ukraine will need to include U.S. troops. Speaking with Bloomberg's editor-in-chief John Micklethwaite there, Zelensky said that his European allies don't have enough soldiers to pose a realistic deterrent to Putin. The comments followed Trump's threat to impose financial penalties on Russia if it doesn't end the war soon. The historic winter storm impacting southern states have led the NBA to postpone a game in New Orleans. Wednesday's matchup between the Bucks and the Pelicans was shelved after a foot of snow fell on the city. A makeup date has not been determined given the ongoing conditions, with tonight's scheduled game also in jeopardy. So a little bit more sports to end there for you. That's your brief, John.
Danny has some weather too. We appreciate it. More from Danny in about 30 minutes' time. Snow in Louisiana.
Yeah.
Who saw that coming?
Yeah, seriously. It gives people practice, though, with snowmen and such, which I saw. They did a pretty good job.
They've done a great job.
That was
Yeah.
impressive.
Colder there than it is here.
Indeed.
Which is remarkable. Absolutely remarkable. Up next on the program, competing with Trump's United States.
Everybody is going to be competing for the people that they either govern or lead, and that's exactly what you're going to get in Donald Trump. It's somebody, he hasn't been shy about the fact that he wants America to win.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Listen carefully. Can you hear the rhythm in the markets? just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Counting it down to a really important event a little bit later on this afternoon, the President of the United States addressing this forum right here, the World Economic Forum here in Davos, Switzerland. And a president, which we mentioned yesterday, Lisa, who feels vindicated, feels like he's been proven right. All the warnings he had for the Europeans all those years ago, 8 years ago, turned out to be the correct warnings, Lisa, to make.
He feels vindicated, and he also feels loved, which maybe was different than back in 2017 when he first was accepting his role as president, because a lot of people are saying to him, how can we work with you? We think your policies sound great. We want to be more like you, and expect to hear more of the same, at least in public.
Because things in the United States are decent. They're okay. In Europe, things are challenged. Under surveillance this morning, competing with Trump's United States.
I think it's important. Everybody is going to be competing for the people that they either govern or lead, and that's exactly what you're going to get in Donald Trump. It's somebody, he hasn't been shy about the fact that he wants America to win. There's nothing negative about wanting the best for your country and the people that you lead, and I think that people want to see him do that, and that's why he won re-election in such a big way.
Let's continue that conversation now. Joining us, Joe Taylor, the Ontario Teachers Pension Plan CEO. Joe, good to see you again.
Thanks, Jonathan. Great to be here.
Thanks for being here. Last year, we talked about the difficulty in doing business, say, between Texas and California. Maybe we should start much bigger than that this time. Canada versus the United States. What's behind that tension at the moment?
Well, I think saying we're the 51st state's a bit of an opening salvo to that discussion. You know, I would say from our point of view, you know, we're an international investor. We invest all over the world. We probably approach this one from the perspective of saying, probably feels a bit like the sort of discussions we have with our companies and our partners, right? So you try and kick off with constructive collaboration. If that doesn't work, probably move more towards negotiation. If that doesn't work, well, then you have to be creative.
Does it lead you to rethink some of the exposure you take in either Canada or the United States, the kind of companies you want to be owning, the kind of companies you want to stay away from?
Yeah, interesting question, one we've been thinking about. You know, we have a significant investment in the US. It's been a very profitable market for us for 20-odd years. I guess the rethinking is probably more along the lines of how do you essentially avoid just continuing to put more and more money into the US? There's been lots of initiatives that's drawn capital into the US. The markets have been very hot, as we all know, the last couple of years. You know, we try to run a diversified international portfolio. So in some ways, it's actually, you know, where in the rest of the world do you see growth and do you see a return on the risk you're going to take?
This is interesting because a lot of people are saying the same thing, and we're seeing that in the performance of markets, which is the reason why we're talking about European equities performing so well.
Right.
Is that really your takeaway, that maybe places like Europe or even in Southeast Asia offer a better return proposition in the year ahead, given that the United States already has so much capital, and some people are saying is priced to perfection?
Right. So we invest in both private and public markets. I would say on the public side, you know, you can take a debate about the relative value that exists between European and other markets in the US. I think the one that's really interesting in some ways is the active private market, where we do a lot. So for those that don't know, that would be things like infrastructure, private equity, credit. I'm a great believer in go and hunt where the others don't want to tread. So a lot of the Americans at the moment are actually saying, I only want to be in the US. And they've been saying that very openly in Davos. To me, that's great news. I'll just fill my boots in Europe.
Okay, so Europe is the place to go instead. That's what you're
It wouldn't be exclusively Europe, but I think within Europe there are still some great companies. There's still some growth, albeit it's probably, you know, you have to actually pick your company and pick your spot. The thing that Europe's had for a long time is a pretty predictable regime in terms of regulation, and you've also got currency, which is relatively stable to the Canadian dollar, which we like. Beyond that, you've got businesses that are of a size where we can invest in them. We're quite a large plan, so our ticket size to invest is relatively significant. And if you're doing that, you want a professional management team, and there are plenty of those in Europe too.
I'm sure you can't name the companies, but could you describe some of the themes within Europe that you'd like exposure to, the things you're actively focused on?
Yeah. So we still believe in climate change. It's one of the things, another part of the discussion at Davos this week, where it's really moved all about AI and data centers. Climate change is going to continue to be in focus. If you live in LA at the moment, you'd certainly say that was an issue for you. So we're still investing around the climate transition. We've done a lot in electricity transmission, that last mile delivery, new types of power or different types of alternative power. And I think then beyond that, what we're trying to do is to be thoughtful about disruptive technologies where we can actually move into a new area, which isn't just AI. So, hydrogen and so other fuels that are interesting. We're also very active, unusually for a pension plan, at the more venture-style end in terms of looking at new disruptive companies. And some of them aren't in AI again, but a lot of them are sort of morphing to that area. We really like technology that enables other sectors. So we like technology that enables the financial service market, healthcare, those sort of areas. And that covers quite a broad church, but we can get into those businesses because we provide long-term patient capital. And in some ways, we're an alternative to an IPO. We can be there for 10 years and really help the business to scale.
Ontario Teachers Pension Plan has actually been one of the pioneers in really sourcing a lot of private deals yourselves and going in there and having a really big presence. I'm just wondering if you think the pendulum has switched from private equity and venture, it went to private credit, and now do you think it's switching back from private credit, which has gotten very crowded, back to more of the equity style private investments?
You're always going to see a bit of this tactical moving around. We've been investing in all of those sectors for 25 years, and we have an outlook which is 50 years out. So there's always going to be a place in my heart and in our portfolio for things like private equity, infrastructure, and credit. Credit's a little bit cyclical. The spreads tighten up when everybody wants to chase the same sort of deals. And I think with private credit, you've really just got to be careful you're not putting the same product into the same business. So I wouldn't do private credit with an equity strip in the same company. But there are opportunities around there. For us, the trick is to get a balanced portfolio that is diversified. We're quite a mature pension plan. This is our 35th anniversary, so happy with that. And, I have those 340,000 teachers in Ontario, and I need to make sure they're not anxious about their retirement.
Well, happy birthday to the firm. It's good to see you, sir. Thank you very much. Joe Taylor there, the Ontario Teachers Pension Plan CEO, on opportunities outside of the United States. I'm still thinking of what Katie Koch at TCW said to us a little bit earlier. 4% of the population, 1/5 of the global economy, and 2/3 of the market cap. It's pretty stunning stuff, Lisa.
Yeah, and that's the reason why there's so much focus. I do think going forward, this is going to be a question, though. How do you rebuild? How do you get some sort of sense of prevention going forward?
Up next on a program, we'll get into that. We'll catch up with Morgan Stanley CEO Ted Pick, the EQT CEO Toby Rice, Nina Richardson of ADP, jobless claims just around the corner, and we'll catch up with the CEO of Infosys.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of the regulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The U.S. is going to continue to attract capital.
When you think about the U.S. economy, it's in a good place.
There is reason for optimism. There are green shoots that people are able to point to.
The ability to be successful, the rules, all that has really driven strong growth in the United States.
As America goes, so goes the world.
This is Bloomberg Surveillance, live from Davos, with Jonathan Farrow and Lisa Abramowitz.
American executives have totally taken over this forum. At the World Economic Forum in Davos, Switzerland, good morning to you all. Stateside just waking up, the big event later on this afternoon. The President of the United States, Donald Trump, calling in to this forum. And a lot of questions from American CEOs and European CEOs, Lisa, already lined up.
I love that he's calling in because we were wondering, did he even feel the need to be a part of this event where he's already dominating it about the will he, won't he kind of discussion. Now, there could be some real questions, maybe. And we were talking about that. How much is this going to be a forum for executives to talk about how much they appreciate him and they like what he's doing and please don't hurt us and make our business life much better versus actually trying to clarify some of the vagueness right now?
I was listening to Guy Johnson of Bloomberg a little bit earlier on out of London, and Guy made the point that markets were like this, a clenched fist. Donald Trump's come in and there's a release. A lot of people just relaxing, just a touch. Should they be? When it comes to trade, that's got to be the focus. A threat of 25% tariffs on Canada, on Mexico, 10% on China. And the message for the Europeans, you might get it too. That's still on the table here, Lisa. Now, whether your operating assumption is that that's just negotiation and we'll end up somewhere else, that still looms large.
What's fascinating, though, about Davos is that the discussion has changed from will tariffs hurt Europe to Europe, let's get our business in order. Let's deregulate to some degree so we can compete better with the United States. It is a different tone, and that is where people are getting more optimistic, actually, about the European continent, certainly when it comes to investing.
We've asked that number one question repeatedly. How little needs to go right in Europe to generate some big gains, because the bar right now is really, really low. I'll go back to those numbers from Katie Koch at TCW a little bit earlier this morning. 4% of the global population, 1/5 of the global economy, 2/3 of the market cap. That right there is US exceptionalism in 3 numbers. That right there is dominance.
Yeah, and Joe Taylor, though, is talking about the capital is there. Now the question is, how do you put more capital on top of that capital and actually have a really good return? It's getting harder, and that also is a conversation that we keep having.
Let's head over to the nation's capital and catch up with Anne-Marie in Washington, D.C. AMH, we're all waiting for it, an address from the President of the United States. What's in store?
That's right. He's headed to Davos this time, though. This time around, he's going virtually. Not exactly sure what he's going to say to this group of global elites, I think, as he would call it. But based off what he said in the past, I think, Jonathan, you nailed it yesterday when you called it a level of vindication the president is going to have. Because in the past, he lectured this group about being enslaved to Russian energy, about outsourcing their entire defense on the United States and only spending 2% of their GDP. He'll likely call for more defense spending, and also probably will talk to them about tariffs. This line stuck out to me from President Trump in 2020. They have trade barriers where you can't trade. They have tariffs all over the place. They make it impossible. They are frankly more difficult to do business with than China. So I can expect potentially some of that tone with the group of Europeans. What's going to be interesting is the Q&A portion of this. Now, these aren't journalists, and these are likely people that want to curry favor with the 47th president or those that already have. I'm thinking of Steve Schwartzman, so that's likely going to be a softball question. But potentially we can hear things like deregulation, what these tariffs and trade may look like, especially from Anna Botin of Santander, or what the energy landscape may look like in the United States from someone like Patrick Pouyanné from Total.
Anne-Marie, looking forward to the coverage a little bit later. Look out for that 11 a.m. Eastern Time. No softball questions here. Joining us, the Morgan Stanley Chairman and CEO, Ted Pick. Good to see you.
How are you guys?
Good to catch up with you, sir.
I got a little rattled when we were about to start because you said big event. We're coming up to a big event, and I thought it was our interview. And then you're like, oh.
Should I restart?
Yeah, let's restart.
You're sort of like,
all right, let's restart.
I was like, okay, this is, I'm like filler.
We're going back to T-shirt. All right, you ready?
Yeah,
that wasn't live. This is the real thing.
Okay.
Live from Davos, Switzerland at the World Economic Forum, the big event. Ted Pick, the Morgan Stanley Chairman and CEO.
Fantastic.
Good to see you,
guys.
sir. 1 year in the seat.
Yes.
It's flown by, hasn't it?
1 year and 3 weeks.
How's it feel?
Amazing.
Yeah.
You know, you come into this job and you want to do good, but what you discover is the quality, the underlying franchise and the people, and it's a wonderful franchise. They got the keys to a great car, and the partnership is alive and well.
Now you've got to hit the ground running.
Yeah.
American bankers running around CEO, very, very, very happy here in Davos, Switzerland, these CEOs and American bankers. Are you one of them? Are you optimistic about this year ahead? And what is it about the incoming administration that gives you that confidence?
Jonathan, I am positive because it is definitely a change in tone. It just feels like the overall framework is one where there's going to be more interaction between the public and the private sectors. What you guys were talking about last couple of minutes, it can't be state actors alone, and it can't be private companies alone. So the fact that there's real dialogue building, I think that's a huge plus. And on the European question, sort of interesting comment too, because I think there may be some catalyst to some now reflection. You know, there were the Draghi papers. Did people read it? They kind of read it, but there was nothing. Capital Markets Union, Banking Union, kind of European sort of self-strength. Maybe this is a catalyst to some real conversation. So in that sense, I think it's positive too.
Are you hearing about actual business activity stemming from that change in tone in Europe, or is it just sort of a conversation at this point?
Well, I mean, we're like, 25 basis points into the new administration, right? We're just getting going. But yeah, a hell of a lot more than you would have expected 2 or 3 weeks ago. I think it's, you know, it's constructive.
One thing in your earnings that really stood out was the stock trading revenues that really boomed. And I'm wondering, this has been a discussion about how risk-on things have been feeling, certainly at Davos, but through the last couple of months. Do you see that waning at all, or is it just continuing to amp up in terms of risk-taking?
Well, you know, when you become a CEO, one thing is for sure, all of your children are equally beautiful, but our equities business is one of our more beautiful children that I adore. And yes, they put up some great numbers. And I think that is a reflection on just the quality of the underlying franchise, but also a sense that people want to allocate to a little more risk. But importantly, they kind of want to get beyond the index level. You guys talk about this a lot, right? Sort of index level equity risk premium relative to sectors. And I think one of the positives here is we're talking about deregulation in the energy space and energy transition. We're talking about the financial services space. And yes, you need to own the 6 because they are money machines and great companies. But how about the rest of the 493, 494? And I think some of that dispersion getting kind of allocated across themes and sectors and around the world, I think that's a multi-year trend. I think we're early on that.
Concentration is certainly a risk factor that a lot of people are considering. Another one is the deficit. and the cost of interest payments for the US government. For you, for the capital market business, is that a risk more generally that you and the team are focused on?
Yeah, you've been talking about that a lot, and and I think it's important because if you don't talk about it, it sort of says, you know, there's no canary in the coal mine, right? But I do think there is the fact that there has been so much attention given to this, and you have folks like Besson coming in who know the bond market, that it has a sort of reaffirmation that we got to look out on that. Simpson Bowles, you know, here we are these years later. That having been said, you know, term premium is still pretty narrow. So, like, we haven't seen the long bond really move, so there's an underlying confidence. I think the question is, what kind of growth can we generate? I think so the conversation that one would have is, which comes first, sort of the potential inflationary effect of tariffs or the positive deregulatory effect? And I think that's going to be one of the things we know is that there's going to be an ongoing dialectic, you know, which policy function can be transmitted more quickly than the other. And I think that pivoting and transitioning and the dialogue is important.
Do you think it holds back activity? That degree of uncertainty, given how confident everyone is, and Lisa especially, me too, we get nervous when everyone in Davos gets really confident.
Yes, contraindicator.
Does it hold back activity without having the clarity on what these changes are going to look like?
I think part of the dilemma is that the vernacular of whether we're really moving with animal spirits is whether we see a bunch of M&A prints. Like, where are those M&A announcements? And the reality is, over the last number of years, we've had, I think, two major uncertainties, right? The end of financial repression, 0 and 0, is that finally passes, and do we kind of know where rates are going to be? And we can focus on the detail of whether there'll be, you know, 1 or 2 moves or none at all, but at least we generally know that for the next period of time, the U.S. risk-free rate is somewhere in the mid-4s. And then you can apply discount rates for country risk and the company and the rest of it. So that's kind of past us. So that's an uncertainty that's taken off the table if you're a CFO and you're in a boardroom. The second set of uncertainties has been around sort of the end of history, which is the resumption of nation states and the like. And one could argue, well, there's a lot of uncertainty in the world. I would argue the combination of having some sense of a rate framework and having some sense that things are going to happen in the U.S., in Europe, around the world, I think it galvanizes the corporate community. And so the question is, how much is the market discounted at? How fast will that be? And I do think important catalyst to this will be, there are the better part of 1,900 companies in the private equity space that have $1 billion of aggregate value, 5 years of life on average. Those companies need to move. So at some level, I couldn't tell you exactly the pacing of that activity, but we've been below trend line in the M&A market. We talk a couple of years from now, I think we'll be a trend line or higher. I'm pretty confident about that.
You think it's going to be M&A? You think it's going to be IPOs?
I think it'll be everything. I think we've been talking about, you've talked about so much the sort of paucity of investable names, especially when you get past the big 7 companies and they're sort of small cap orphans without research. I think there's yes, it can be painful, Starbucks, for a young company to be public, but you get enduring long-term value from shareholders that actually can also add some value, and you can use that currency to make other acquisitions. I think the IPO product is alive and well, and I think importantly, what's happened is a sort of financialization of the markets is the intersection of private and public. That's come of age. So maybe you don't go public in the classic NASDAQ, New York IPO at the first. Maybe you do some hybrid capital for a while, and then you go public a la Uber with a full capital structure.
One area that you've brought in, one of your babies that's very beautiful that I'm sure you talk about, is your wealth management unit. And
yes,
I'm curious
that's
about...
a big baby.
It's a big baby.
Big, beautiful baby.
It was one of the drivers of revenues for a very long time. What's been the challenge in accumulating assets in the wealth management, growing assets to the degree that you really have wanted to?
Well, you have a massive denominator, right? And I think what's happened is we're now the better part of $8 trillion of AUM between wealth and investment management. If you look at sort of point to point, what have assets done? And obviously higher markets helped. The assets in 1 year went up by $1.3 trillion. So people say, okay, you raised 250. Well, that's a huge number. And for me, Lisa, what's really important is, how is our funnel working? Like, think about our wealth business as sort of having 3 parts. Self-directed E-Trade, we're seeing transaction activity really kicking up. That's clearly a positive signal, part of what you were asking about in the sort of pure equity space. We have this workplace business. I want your stock plan business, because then I can do factory floor to CEO. And then the fee-based advisor. 50 basis points per annum. And the fee-based advisory growth is quite impressive, and is going to continue for years to come, especially if clients need to allocate across sectors.
You've made a lot of acquisitions in the past. Any in the pipeline, planning any further types of tie-ups yourself?
You know, it's interesting. We see stuff, but I really love the durable growth organically that we have in the two major businesses, the investment bank and the wealth and investment manager. But over time, we'll continue to look at stuff as we accrete capital. Sure.
We've got 1 minute left.
Yes,
I want to
sir.
squeeze this in. Have you spoken to the president?
I have not.
Not recently.
Right.
If you had the opportunity to, and Davos will today, to throw a question at the incoming president, the current president, Donald Trump, what would you ask him?
I like the quality of the questioners you have. I do. I like the quality of the questioners
If your
you
name
have.
was in the mix and you had one, what would that question be?
He tried to punt by saying he's not going to do it.
I think the question I would ask is one where it would give him the opportunity to sort of speak to the possibility that he's thinking about a lot of different possibilities on a lot of different issues. Something along the lines of, are you open to taking idea flow around a whole bunch of different spaces and give examples? And I think my guess is the answer that he would give is yes, and I'll give you examples of that. And the reason that's important is because I think we're so early in this administration. People are trying to sort of weigh how much is tactical versus how much is baked. I think there's a lot of discussion, and people, it wouldn't be so much for him, but people understanding that there's a real conversation taking place on a whole bunch of important issues, and we're only 5 days in. I think people hearing that will give confidence that we are in the early stages of the dialectic, and there's more to come.
Ted, appreciate your time. This was a great
Thank you so much for having me,
conversation.
guys.
Thank you, sir. Safe travels back to New York.
I'm an avid listener and watcher.
Well, we appreciate that.
You've got to come on again soon.
Ted Pick, the chairman and CEO of Morgan Stanley. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Fire crews are battling a new fire north of L.A. The Hughes fire broke out yesterday and quickly spread to 10,000 acres. About 50,000 people are under evacuation orders and warnings in the region. The fire is currently 14% contained. More details emerging involving President Trump's plan to make the U.S. an AI powerhouse. The information reporting that SoftBank and OpenAI each plan to commit $19 billion to the $100 billion project known as Stargate. The tech outlet says that the two companies would both own 40% of the endeavor. Tech industry players like Elon Musk have been questioning the lack of details around the venture and its financing. And the New York Jets have found their next head coach. Former Detroit Lions defensive coordinator Aaron Glenn has agreed to become the franchise's next coach after interviewing with 5 other teams. Glenn joined the Lions in 2021 and becomes Detroit's first coordinator to be hired by another team since 1963. He was drafted by the Jets as a defensive back in 1994 and played 8 seasons with the team. That's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, priced for perfection.
The dominant mood is extreme optimism. The question that we need to push ourselves on is it sustainable and how much further can it go?
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
The opening bell, 1 hour and 12 minutes away. Going into that opening bell, equity futures down by about 0.1% on the S&P 500. Big conversation at the World Economic Forum with market participants. Yes, things are good. Sure, this economy could get better, but are we priced for perfection?
The dominant mood is extreme optimism. A lot of that optimism is priced into the markets. And this idea of U.S. exceptionalism, just to put that into context for people, just factually, the U.S. has demonstrated exceptionalism. We're 4% of the world's population. We're 20% of GDP. We're 68% of global equity market capitalization. So that's factual. The question that we need to push ourselves on is it sustainable and how much further can it go?
Lisa, that dominance is incredible. We've mentioned those numbers a few times. 4% of the global population, 1/5 of the global economy, and 2/3 of the market cap. Dominance.
And that's the reason why everybody's talking about focusing on the United States. The key here is just trying to get past that to understand what they're actually doing with their money.
Counting it down to the opening bell. Let's get you some morning calls. Let's cross over to Manus Cranny. Hey, Manus.
Jonathan, first up, we're going to kick off with Goldman Sachs. They're lowering the price target on Apple to $280. They actually say dominance here may be shifting, citing lower iPhone sales. And you got it, competition from China. What carve-out might they get on the tariff story? Next up, Bank of America raising the price target on Meta to $7.10, highlighting optimism on the company's AI capabilities. It's the sprinkles on top. And finally, research upgrade for Netflix to outperform, pointing to strong fourth quarter results and easing growth concerns. Just remember those belter of numbers that we brought you yesterday. 19 million subscribers in Q4. John.
Manus, thank you. There is going to be a huge investment in AI and associated data centers in the United States of America and worldwide. Lisa, we've already seen that. That is about to get even bigger. That means there's going to be some serious energy demand. So let's talk about that with the EQT CEO, Toby Rice. Toby, good to see you, sir.
Hey, guys.
Gas is in demand big time. Let's start with you on M&A. I want to start with mergers in the incoming administration, the new administration. Got to get used to saying that. It's been difficult to make deals under the Biden administration. Is your life about to get a little bit easier?
I think our lives are going to get a lot easier, not just from M&A. I mean, I think you look at this energy market that we have right now, when people are scratching their heads. I mean, we are producing record amounts of energy in this country. If you added up the oil and gas that's being produced in America, we're producing over 30 million barrels a day equivalent. Now, you would think that that would translate to lower energy prices, but energy prices for Americans are up over 35%. Now, if you're scratching your head, you're like me, and the reason for this bizarre facts that are happening is because political force has overwhelmed market forces when it comes to energy in America. It's never been more difficult, and the past administration has made it incredibly difficult to get energy projects built, whether that's pausing LNG or requiring an act of Congress to get a pipeline built. Having Donald Trump come into office is a very welcome change, and we hope that we will let market forces take a backseat and let market forces drive the cheapest, most reliable, cleanest energy to the marketplace.
I'm looking right now at natural gas futures. They have ticked up. They are just below $4 a barrel. They were as high for $4 per unit, which I'm not familiar with, which you can tell me, but the highest was going back to 2022. I'm crushing it here because I know so much about it, of almost $10. Why has it declined so much? I mean, basically, is it difficult to get investment at a time where you're not seeing the requisite increase in prices?
So natural gas prices have been incredibly volatile. Just think about it. Right now, we're looking at a natural gas average price of about $4 per million BTU.
Thank you.
In 2024, that was about $2.25. That's a big swing. Now, for perspective, people need to be reminded, $4 natural gas is the energy equivalent of $24 oil. So this is still the most cost-effective energy solution that's out there. What's going to be driving natural gas prices? Simply put, there's going to be a lot of volatility. We've seen natural gas demand increase 50% over the last 15 years. The pipelines to service that demand have only grown 25%. And most importantly, the storage infrastructure to buffer the price and supply and demand has only grown 12%. And so that means that price is going to be the buffer, and that means volatility. And we'll see periods of time where prices are $2. We'll see periods of time, like we saw in 2022, where prices were north of $6. You've got to be a low-cost operator like EQT to weather the storms and give your investors exposure to what we think is really compelling upside.
So the key to being resilient is both being a low cost, being big enough, and having the access to building what you need in an expedient manner. Which do you see happening for yourself? Do you plan on being part of any acquisitions on either side, or trying to build in some kind of way, given that permitting is probably going to get a whole lot easier?
Yeah, our strategy is very simple. Starts with our North Star becoming a low-cost operator. With the Equitrans transaction that we just completed, we have completed our transformation of EQT. Over the last 5 years, we have built an incredibly high-quality company. We've increased our productivity and scale by over 50%. We've almost doubled our inventory to have decades long of inventory. We've lowered our cost structure by 30%, and we've doubled our free cash flow per share capability. So this is a very strong, healthy business, and it's incredibly important for us to be able to be strong so that we can meet the needs, because the demand for natural gas is incredible, whether you're talking about providing energy security to our allies, lowering American energy bills, powering the data center build-out to fuel this AI revolution, or simply making the environment, lowering global emissions by replacing coal. 20 to 40 BCF a day, which would be a 20 to 40% increase in natural gas demand, is coming over the next few years. And as America's natural gas champion, EQT is ready to meet that demand.
Toby, we'll hear from the president a little bit later at the forum. He's calling in from Washington, D.C. I mentioned this to Ted Pick of Morgan Stanley earlier on, about 10 minutes ago, actually. I asked him, what would you ask the president? What is it that you want to know from the president of the United States?
You know, it's very clear that what needs to happen with energy is we need to get back to letting market forces drive the energy that makes its way to the marketplace. You know, making sure that permit reform is key to making sure that happens. I think permit reform is inevitable because we are in such a fragile state with our grid and our energy system. We're either going to be reactively fixing permit reform, like what Germany did in 22, where they got energy projects approved in 5 days when it used to take them 5 years, or we can be proactive and get ahead of this. So permit reform is going to happen. I think the most important question to ask is, you know, it's one thing to let market forces work, but what can we do to incentivize these market forces to drive, you know, not just the clean aspects of energy, what can we do to incentivize the reliability of our energy system, which has been significantly attacked over the past few years. We are in a hole when it comes to that, and we need to get back to incentivizing reliable energy systems.
Toby, appreciate your time. It's kind of you to drop by. Thank you, sir.
All right, thanks, guys.
Toby Rice there, the EQT CEO. Lisa, a lot to get through there, but ultimately a shift, a new era potentially for the energy industry.
Per BTU. Per BTU.
You know. Anyway.
Just kidding.
Should we go?
Yeah, let's get out of here.
All right. Coming up next, Nina Richardson of ADP and a jobless claims report. We'll bring you some economic data in just a moment. We'll catch up with Mike McKee, live from Davos, Switzerland. You're watching Bloomberg TV.
Get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
We've been fairly light on economic data. We'll get some in just a moment. Jobless claims just around the corner. Light on Fed speak too, which is a good thing sometimes. It's the blackout period. We'll hear from the Federal Reserve next week. That Fed decision is a little less than a week away. Equity futures right now on the S&P down 0.1%. We are negative on the Nasdaq by 0.5. Sneak peek of the bond market going into this economic data before we get over to Mike McKee. A 2-year, 10-year and 30-year. A little bit of a lift of the long end yields higher by a basis point or two. Let's get across to Mike McKee for that data. Good morning, Mike.
Good morning, John. Well, we're basically seeing a small rise in jobless claims, 223,000, which is up from the originally reported 217,000 the prior week. We'll see if that is revised. 1,899,000 continuing claims, and that's an increase from a revised 1,853. Let me just check here, and we'll see if there's a seasonal impact in here. Unadjusted claims, 284,000 is down 68,000. The seasonal factors had expected a decline of 75,000. So this is probably just a seasonal jump from the seasonal factors, not a real change in the outlook for unemployment claims at this point. We're just coming out of the season in which we see problems in the markets because, or in the claims because of holidays. And one last note here, California. Jobless claims last week only up by 6,700. They were up 13,000 the week before, so we're not seeing a major jump in claims yet from California because of the fires.
Mike McKee, appreciate it, sir. I think that's going to be a big question for a lot of us as we anticipate incoming information. Just how much disruption will we get in the economic data? Katie Kosh at TCW, of course, affected by those fires directly. She talked about that earlier to us. But the Los Angeles region, that's a bigger economy than where we're sitting in the whole of Switzerland. Elisa, that's going to be a big issue for the incoming economic data. And I will say this, a small upside surprise on jobless claims. If you take a look at the bond market, 2-year, 10-year, 30-year, as Mike McKee was speaking, Lisa was aggressively typing up on the laptop on the Bloomberg terminal, looking for the intraday move of a 10-year and 30-year bond yield. And Lisa, just slipping back just a touch, not a big move, but slipping back just a touch.
Slipping back a touch as people take a look at the idea that not only did you see a small upside surprise in ongoing initial jobless claims, but the continuing claims you saw actually tick up to almost 1.9 million. So this also signaling the sense that, you know, around the margins, maybe things aren't as robust. I will say the most interesting market move was dollar-yen. And you saw the dollar weaken versus the yen more significantly ahead of that Bank of Japan rate decision. Again, good evening, Tokyo. A very large focus on some of these potential moves.
Joining us here in Davos, Switzerland, Neela Richardson, the Chief Economist and ESG Officer over at ADP. Neela, good to see you as always.
It's great to see you, even in coats, even outside, but boy,
it's quite a view, eh?
View.
You can't complain about that. It doesn't matter how cold it is, and we've said this repeatedly, it's colder back home than it is here, so mate, we've got away. We got away from the cold weather. Neela, everyone's run around Happy Valley, very happy with themselves about the US economy. How do you read things? Jobless claims up just a little bit, but still historically very, very low. What's your read on things?
Things are very stable right now, but I don't think that stability will stay. I think that there is a lot of stasis in the labor market. You can see it. You can see it with these very low jobless claims numbers that just came out. We're at 2-year lows. We're lower than we were going into the pandemic. But I do think you see the threads starting to fray when you look at initial jobless claims. It's taking longer to get a job. We're seeing the wage growth, pay growth come down a bit more. And so there's a little less heat in the labor market fire. I hope it's not a cool down, but it's too early to tell.
It feels like these things have been going on, though, for quite a while. And we've had a few head fakes along the way, particularly in the summer around the labour market. It seemed to spook the Federal Reserve. Since then, things have changed. What is it that you see that says that things are going to break one way or the other pretty soon?
So I look at the dichotomy in the labor market. I look at the difference from cyclical to non-cyclical industries like healthcare, which has been the driver of growth in the labor market, versus manufacturing, which has been on its heels for a very long time. I look at the dichotomy between large firms, which are really motivating all the gains in the labor market, versus small firms that are struggling. So that's where you're seeing the pockets of weakness, and those pockets of weakness could be, as manufacturing surveys have been in the past, a leading indicator to the entire U.S. economy. When manufacturing typically slows, the the U.S. economy is quickly to follow. I keep saying global because we're here in Davos, but I keep saying global because the U.S. is driving global growth right now. So if the U.S. slows, so does global growth.
Which is the reason why people are taking a look at some of these numbers and saying, how much can we actually read into it? And John was talking about Los Angeles and some of the distortions there. And I just wonder, is this basically the new reality that every data print doesn't give us that much? Are you seeing something that gives you a sense of just how much momentum there could be or couldn't be behind it, where you can look through those distortions more easily?
I don't think it's time to look through those distortions. That's why I'm glad I work for ADP. I'm going to give a plug for fine-grained data. The fact that you can go into a locality, look at the workers, see the disruption and its effect on hiring. It's going to be super important. So I'm going to be looking at Los Angeles County, a big job center, in terms of displacement. What industries benefit from the massive and really sad displacement we've seen in that county? Leisure and hospitality. We've seen a slowdown in leisure and hospitality hiring. I see that picking up in LA County because so many people fled to hotels and restaurants. I'm looking at forestry. Eventually, I'm going to be looking at construction. We need that fine-grained data because we need to understand the disruptions and how they affect the overall market.
This is a near-term disruption. There's a bigger-term disruption, a longer-term that we've been talking about here at Davos extensively, and that's artificial intelligence. And I know that your firm and you have been doing a lot of work on what the implications are for the labor force. Are humans going to be needed in about 10 years?
I hope so. Now, you didn't ask me if economists will be needed in 10 years, luckily, but humans for sure. You know, we've partnered at ADP with the World Economic Forum on the Future of Jobs report, but it's really about not the job, it's the task underlying the job and getting the worker ready for continuous change in how their tasks evolve. And I think this point is missed when we talk about generative AI. We're still talking about jobs. Jobs are quickly becoming old-fashioned. It's really about how those skills move the worker through the transition of technology. Unfortunately, workers feel unprepared. We did a global survey at ADP, the People at Work survey, 38,000 workers, 34 countries, and we found that 24% of those workers don't feel like they have the skills they need to advance their careers in the next 3 years, let alone the next 10.
So what does that mean? That some older generations are just going to basically fall out of the workplace as younger generations learn how to adapt faster? Or is there some other broader implication?
You know, that's such an interesting question because you match what we're hearing about generative AI and technology and advancement with what we know is going on with demographics and aging. We're not talking about the number of skills walking out of the door of the U.S. labor market every day as boomers retire. Like, how do we retain that institutional knowledge, that people connection, and match that with technology? We're losing skills every day. So my thought is, how do we retain those skills lead to more flexible work environments, keep people attached to the labor market longer, maybe in non-traditional ways, so that we can help workers transition through these megatrends that we're seeing.
I worry about graduates. I worry about the younger generation quite a lot with regards to AI. You mentioned them being unprepared. I think they are totally unprepared for a number of reasons, including academia right now, which is, I think, pushing them away from using these tools, which can benefit them. We've heard a lot about that. You're living it. That's point one. I would say point two also, and you've talked about this repeatedly, that they just don't have the skill set, the soft skills, and they haven't been working on them either. And as an additional point I'd make as well, Lisa, and I keep going back to a conversation we had with Brian Moynihan of Bank of America, not this year, but last year. This is my worry. The banks are going around saying that they're going to be able to do more with less. So each and every dollar of revenue they're able to generate, it will become less and less labor intensive. That might not mean layoffs on the whole, but it will certainly mean a lower recruitment and potentially out of college and university. And Nita, I want to understand from your perspective what your advice would be to a graduate, maybe a software graduate who was told, you know what, go and learn to code. 4 or 5 years ago, they've gone and done that, and then all the tech firms are turning around saying, yeah, we might not need that anymore. What's your advice to them?
This is the irony. First of all, I'm just going to recognize the pain point that they're going to face in this labor market, because skills have never been so easy to acquire and so hard to retain. Because technology is moving fast. As soon as you learn that coding language, it's already changed. And so my first piece of advice is to really evolve with the technology. It's not enough to just rely on your degree. In fact, our survey says that degree holders feel no more prepared than non-degree holders when it comes to skills. The second thing is those soft skills. They never go out of style. Learn how to use the phone, network, call people, like meet for coffee, engage with people, interact with them, collaborate, evolve, learning from different demographics. You have the benefit of 5 demographics under one work site. Use it to your advantage.
There's another aspect to this transformation that's pretty interesting, which is the skills that are harder to replace with AI are things that are traditionally more blue collar, that are actually people who are, making things, that are building things, that are teaching people, that are caring for people, et cetera. Is there a shift where you're going to start to see some of the office-related jobs shrink and some of these others really build out?
It's funny because at ADP Research, we actually quantified that change. We saw coming out of the pandemic the Gen Z increases in blue jobs and manufacturing and producing stuff, because so many of those jobs were lost during the pandemic and they had to be rehired quickly. But if you match where the jobs market is to where the demographics are going, that care economy fuels the economy. So if we don't have nurses and healthcare providers, which is a physical, like in the room kind of job, to help us with this aging transition in the United States and in higher income countries, then we don't have an economy to fall back on in terms of other things we'd like to do. The care economy is the backbone of the entire economy. So there are jobs to be had there.
Nita, I'm pleased to do this in Davos, Switzerland. Thanks for being with us. We'll see you back in New York. Thank you. Safe travels. Nita Richardson there, the Chief Economist and ESG Officer at ADP. Reminds me of one of the best conversations I've had this week on the sidelines of this forum. And Lisa, you and I have talked about it. There's a favourite question of mine that I repeat, and you'll hear this repeatedly, I'm sure, in the year to come as well. The kind of disruption that we'd see from AI, will it do to services what globalization did to manufacturing? I asked the gentleman about that this week, turned around and said it would be more profound, but with a difference. It'll be in the reverse. It was to your question, to that very point. It won't be about blue-collar workers. It will be about the highly paid software engineers. That's where you're going to see this great disruption.
And if you look at trends and you look at the data, it's already starting to happen on the margins, which is why if you think about the banks and all of those junior associates, are they going to be needed if you can get an AI system to do it? And then who's going to get the experience and how quickly and how many people? These are the questions that people are increasingly going to be analyzing.
I understand the CEOs want to keep the workforce motivated. I get all of that. They don't want to go around and saying there's going to be huge job losses. But Lisa, there's a part of me that still believes that ultimately that headline at some point is going to cross the Bloomberg terminal, where you start to see those big job losses because they've replicated that work in the business using AI.
From my conversations in the sidelines here, that day is not now. It is not 2 years from now. It is not 5 years from now. The problem is people don't have visibility on what it looks like after that. And that is what my takeaway was from here in Davos, that people don't understand fully the capabilities with Anthropic CEO saying that AI has absolutely the potential to surpass human intelligence, et cetera. There's a lot of unknown underpinning a lot of the
skin in the
optimism.
game there, just a little bit, right?
You think?
Just a little bit. Talking their book, just a little bit. The two biggest themes here, Steve Paliuca said it earlier, of Bain, the Boston Celtics and Atalanta Football Club. You know him well. Steve said it, two big themes this week, Trump and AI, and basically nothing else. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. Recapping the latest economic data, initial jobless claims rose last week by 6,000 to 223,000, a relatively low level. The median forecast called for just 3,000 less. However, it is taking longer for out-of-work people to find a job. Continuing claims jumped to 1.9 million. That is the highest figure since November of 2021. President Trump's acting defense secretary is deploying 1,500 more troops to the southern border to comply with Trump's declaration of a national emergency, Robert Salesses said that he had also approved of the use of military aircrafts to assist with deportation flights of more than 5,000 illegal aliens detained by Customs and Border Protection. President Donald Trump is also planning his first trip since returning to the White House. Tomorrow, Trump will head to the Asheville, North Carolina site, which is still recovering from Hurricane Helene. Then he'll head to California to survey the damage from the LA wildfires. Looming over his trip, questions about federal funding for disaster recovery. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Thanks for this morning and thanks for this week. Programming note, look out for this. President Trump speaking to the World Economic Forum at 11 a.m. Eastern Time. Ahead of that, join Bloomberg.com at 9 a.m. as we look ahead to Trump's address and wrap up this week at Davos. You can listen to some of our reporters here in Switzerland discuss Trump's impact just days after his inauguration. Terminal users and subscribers can put questions directly to our team. So if you want to do that, feel free. Up next on the program, a change in tone.
I am positive because it is definitely a change in tone. It just feels like the overall framework is one where there's going to be more interaction between the public and the private sectors. The fact that there's real dialogue building, I think that's a huge plus.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Live from Davos, Switzerland at the World Economic Forum. Understandably, there's been one thing in focus, the Trump administration. Under surveillance this morning, a change in tone.
I am positive because it is definitely a change in tone. It just feels like the overall framework is one where there's going to be more interaction between the public and the private sectors. It can't be state actors alone, and it can't be private companies alone. So the fact that there's real dialogue building, I think that's a huge plus. And on the European question, I think there may be some catalyst to some now reflection.
That was Ted Pick of Morgan Stanley, and I think on repeat from American bankers throughout this week. Lisa, some confidence out there, that's for sure.
Yeah, and at a time when there is still a lot of uncertainty, the idea of just simply stripping away regulations and having a pro-business tone at the top is really feeding some of the ambition that we hear from a lot of business executives here.
There's a lot of optimism. I wonder what this is going to feel like in 12 months, looking back 12 months. I wonder if they turn out to be right.
Yeah, especially because it tends to be a contrarian signal. Right now, people are looking forward and saying, where is the money potentially that isn't going to the U.S. and could it be going to Europe in particular?
41 minutes away from the opening bow stateside with your morning movers is Manus Cranny. Hey, Manus.
Jonathan, good morning. We talked about United, we talked about Delta. Today we're talking about American. Very different story here. They're going to make a loss of 20 to 40 cents this quarter. They forced customers to book direct. That cost them $1.5 billion, and they have learned their lesson. They've also got capacity constraints. Gee, Larry Culp, great story here today, upping the dividend by 30%. Free cash flow, just under $7 billion, and a buyback. That is really what's driving this, $7 billion of a buyback. I'll leave you with a thought on EA Entertainment. This is down 17%. The guidance was light. Net bookings guidance cut to $7 and $7.8 billion. They're just lightening up on some of their viewership. Jonathan.
Manus Cranny, thank you, sir. We can head over now to Linda Ramin, who's standing by with a special guest. Hey, Haz.
Hey, John, and you said it. It is about Trump and what impact he would have on not just businesses, but economies. Well, with me is Salil Parekh, CEO of Infosys. This is one of India's largest IT companies. Its biggest market is the U.S. Salil, good to have you with us. Lots of questions about how the Trump administration will impact the outsourcing business. What's your take?
So there, I think what we see, first, thanks, Linda, for having me and Infosys here. What we see is many of the policies being put in place, the discussions this week with U.S. executives is all about business becoming more robust in the U.S. So once, if that happens, when that happens, as business becomes more robust with the new approach, we will start to see more economic growth. And typically what we see in those cycles is much more focus on using technology for large programs. So we think it's a positive sign to have that sort of an approach going in. Already we announced our results last week. Last quarter, we had 6% growth. We increased our guidance. Our operating margin was above where the guidance was, above the midpoint of the guidance. So we feel quite good about what this year looks like. And if all of this starts to happen in the U.S., then that looks positive for the future.
Just how good do you feel? Because it was a lackluster year for IT services last year. How is it looking? What are you hearing in particular from your clients in the U.S.?
So the U.S. clients here have been quite optimistic, and their view is with more focus on the economy and with all of those policies coming in place, they are looking forward to more GDP growth in the next coming quarters. And with that, there are new technologies. Of course, there's focus on AI, but there's new technologies in cloud and data and analytics, in digital services.
So spending more.
And spending more in those areas.
Can you actually quantify the kind of spending that you're expected to see in the coming 12, 24 months?
So there, I don't have a number, but what what it felt like this week in all the discussions, especially in the US clients, was much more optimism about the US economy. So we are hoping that translates into our business.
Salil, is also about the H-1B visa. Lots of conversations, debates about whether it should be expanded, pulled back. What's your take on the debate right now?
So there, what we've done is made our business more resilient from a few years ago. So three elements to it. First, a lot more work is being done in India for Infosys from what it was some years ago. We've also built some nearshore capability, for example, in Canada and Mexico. And then our employee base in the US is much more local hires, so not dependent on visas, over 60%. So with those activities, I think our business is more resilient. So we feel sort of, let's say, in good shape, whatever direction we take.
So you're fine with whatever they decide to do. We know from our own story that outsourcing companies have been gaming the H-1B and, we're applying far more than what is needed. What do you make of that tactic?
So there, for Infosys specifically, our approach has been to make sure that we participate to the extent that we need it for our client work. In addition to that, we have large digital centers in the US, and a lot of the work is done by US employees. So we have no...
All right, Salil, we have to leave it there. Salil Parekh, there you have it. Salil Parekh, CEO of Infosys. John, Lisa, handing it back to you.
Hey, Haz, thank you. Thank you very much. That just about wraps up our coverage in Davos, Switzerland at the World Economic Forum. And I can tell you a very different World Economic Forum. Been coming here for the best part of a decade plus. And Lisa, this time, the optimism around a single nation has been absolutely palpable. When we heard from Donald Trump, the President of the United States, and he talked about a golden age for the United States of America, that resonates with American executives in a big way. They've got a spring in their step. The Europeans, not so much. I have to say, the Chinese, the Asian representatives more broadly for the continent, quite absent at this event in a way that, at least in years gone by, they haven't been.
Yeah, they were absent, and Donald Trump was absent until he zooms in later today. I do think it's going to be interesting to see how much there was a vibe shift. And the vibe shift had to do with taking away regulations and being more pro-business than a lot of these nations and companies have been in a very long time. There was much less of that messaging toward whether it was DEI or ESG, et cetera, and it was really down to how do you grow your business. What I found most interesting was the optimism around Europe getting its act together because so much pessimism had been baked in. That was a continual theme through a lot of our conversations. And the big fly in the ointment, underpinning some of the optimism and maybe challenging it just on the margins, inflation worries, and the idea that debt and deficits could go back and rear their heads, the sort of looming cloud of the bond vigilantes.
That is always the looming cloud for you. At the core of everything, core competency and growth. Tremendous growth in America and the lack thereof in Europe, and the divergence between the two. Now, there's tons of confidence amongst American executives, and I said a little bit earlier, we'll see where we are in 12 months' time, looking back 12 months. For all of you, for our audience worldwide, thank you very much for being with us through this week. Thank you very much for choosing Bloomberg TV. This, from Davos, Switzerland, was Bloomberg Surveillance.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race, and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Stalling out at all-time highs. 30 minutes until the start of trading. I'm Katie Greifeld.
I'm Shonali Bassick. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, that rally hits a wall near record highs as traders take stock of President Trump's first few days in office, also digesting a fresh round of earnings, from a surprise loss at American Airlines to disappointing guidance over at Electronic Arts. Plus, Elon Musk and Sam Altman clash again, this time over that $100 billion AI effort hyped by President Trump. All of that and more coming up, but let's take a look at where markets are trading. Like I said, 30 minutes until those bells ring. You can see there's red on this screen behind me a little bit when you take a look at the S&P 500, a little bit more when you take a look at big tech right now. The NASDAQ 100 down about 0.5%, and even a sell-off when it comes to the bond market, a slight one. 10-year Treasury yields currently higher to the tune of 1 basis point. But Shonali, we're back above 460.
That's exactly what I was thinking. It took a few days to get there, but we are there once again. We're also watching some stocks, as Katie was talking about. American Airlines now down 4.3% after forecasting a surprise loss in the first quarter. We're also looking at Electronic Arts, down a whopping 17% pre-market. The video game company cut bookings guidance. GE Aerospace, though, is higher after results topped estimates, and the company announced plans to buy back $7 billion of stock. GE up 7.5%. That buyback story, Katie, is going to be a big theme of this earnings season.
Yeah, absolutely. And I want to focus in on American a little bit and contrast that with what we saw from GE Aerospace, because American Airlines bucking the trend in a bad way. We actually saw relatively bullish outlooks when you think about what we heard from United, from Delta. Not the case when it comes to American, but there are some green shoots, you could say, when it comes to the supply chain. GE Aerospace actually set to open at an all-time high. It definitely helps, like you mentioned, that buyback. Also raising the dividend by 30%.
Totally fascinating. If you look at the S&P Industrials Index, you do see United. You see the GE companies doing much better. They're among the best performers. That chart that showed United Air over the last 1 year up 166%. Just how much American has lagged is pretty staggering, and you have to wonder what that means for competition heading into this year.
Yeah, absolutely. Management matters. And just broad brushstrokes, I think industrials, utilities going to be some of the most interesting stories of 2025. Let's unpack it all now with Ben Gutteridge. He is investment director over at Invesco Investment Solutions, joining us now. Ben, it's great to have you with us. And let's talk at a sector level. Of course, so much attention has been trained on big tech, but you have a lot of movement when it comes to industrials, utilities, like I mentioned. And then you have healthcare, which just can't seem to get out of bed. What's your read when you take a look at all 11?
Well, I mean, it's hard to, well, very nice to be here. It's hard to get too bearish on the sort of that loosely defined tech sector. Valuations, of course, a bit of a challenge, but that has been levied at them frequently in the past. And of course, the earnings are just so impressive for those businesses. But yes, perhaps ripe for a bit of profit taking. I think financials look like a really interesting sector. Enjoyed a good run. Valuations not so appealing as they were as a result. But of course, with a resilient growth backdrop, interest margins as a function of higher interest rate environment, deregulation. I think there is a reasonable, there's a nice balance there. There's a nice complement between financials on the more sort of cyclical element and technology, AI as a more sort of secular, structural long-term theme. So I think they work nicely together.
If you have financials and technology, I am still wondering about the other sectors, because in this week of earnings season, and the big ones come next week, we have started to hit a bit more of a wall. We had blowout earnings from the likes of the big banks, even better earnings this week when you think about the other financials that people were worried about, seeing a significant stock price appreciation. But then you see what happens with American. And then you see some weaknesses in guidance at other companies like Electronic Arts. And do you start to worry that perhaps that earnings strength isn't everywhere?
Yeah, no, I think that's a very reasonable observation. Well done. Sorry to be. Yeah, I would agree with you on all of that. But I mean, I think if we think about sectors, of course, there's idiosyncratic stories, which means active stock pickers can make money in any market. But if we're thinking about the macro sort of backdrop, as I sort of tend to do, you think about growth being resilient, you think about inflationary pressures being maintained, and an interest rate environment where, rates are sort of higher for longer, very few interest rate cuts, if any, this year, then you're thinking about some of those defensive sectors, not quite bond-like, but you think about utilities, consumer staples, maybe they wouldn't have such a good time of it. So certainly active stock pickers can make their mark, but from a sector perspective, I think technology, financials look good, perhaps utilities, staples looking a little less interesting.
Well, let's talk about those stock pickers and how much attention you need to be paying to the C-suite right now. Because to bring up the example of American again, you think about the strategic blunder that they had when it comes to work travel specifically. And it just feels like there's so many idiosyncratic stories right now, even within these sectors. How much does management actually matter here?
Well, management, of course, matters, and you can pick out any sort of single story. But I just don't think the management quality throughout the companies in the S&P 500 is rich pickings there. Some of the highest quality management, the innovative nature, the ambitious nature. I don't get sort of troubled as a sort of a macro investor by the management inhibitants. Of course, you'll see reckless decisions from time to time, but we sort of think like many of the sectors have sort of learned from those decisions in the past. And I just think you're sort of well set up in US equity investing at the moment, such that management or reckless management decisions shouldn't inhibit you from investing.
Sonali, it's really interesting to hear Ben say that, because you think about what happened last year, the purging of the C-suite at the executive level. You think about Starbucks, CVS, for example. There's a dozen others, but from the macro perspective, maybe not as important.
Maybe not, but that's also because of that concentration risk. And it brings us back. Matt Miller's not here today, but he would say next week is the only week of earnings that matters, right? And if next week is the only week that matters, Ben, how much do you look at that concentration risk that's in the equity market and say, I'm going to play into that, or I'm going to find a place to hide?
Well, I guess neither. I would be sort of trying to thread the needle a bit there. I think it's appropriate to be, depending on how you manage your money or have your assets managed for you, to be thinking about having a modest underweight to that concentration risk at this time. But I would sort of emphasize the idea modest, that could be levered that I'm a coward. I would concede that's a reasonable accusation. But as I say, repeat, that these are such great businesses that are driving this concentration. But with US economic resilience and this sort of growth agenda that we're seeing, we could see a broadening out, and would anticipate a broadening out of earnings, and for a bit of a sort of catch-up trade rather than catch down.
Ben, we would never accuse you of being a coward, but let's talk a little bit more about that broadening out, because it broke a lot of hearts, especially towards the end of 2024. And if you're scared of concentration, what do you do here? Do you nibble at an equal weight index or something else?
Well, I think an equal weight index is a very useful strategy at this time. But of course, if you have very high concentration, an equal weight index has greater tracking error, is much more distant from a sort of typical market cap weighted index. So we would promote that idea, but you just have to have that in your mind, that there's a lot more active risk in an equal weight index, given the sort of concentration risks that prevail. And as I say, I think having a little bit more sort of cyclical exposure in the portfolio that, again, would take you away from the market cap risk, given that sort of dominance of tech, things like financials, maybe some industrial names in there as well, perhaps a little bit more small cap, given the regulatory backdrop and the growth platform that we see ahead of us. Looks very interesting. But again, we're sort of not pushing too hard, given the quality, the impressive earnings performance of those stocks that are driving that concentration.
You know, I want to pull out for a minute from the stock market story to the macro story, because we are still getting economic data under the surface, even in a very busy earnings season. And the data from the jobless claims this morning showed that recurring jobless claims are at the highest levels in 3 years. You have less hope in the market for potential for subsequent rate cuts. If you're in the Neil Dutta camp, right, Katie, you can see more cuts being priced in because you worry about that labor market. Where do you stand on that spectrum?
Well, I would say these things are fraught to error in forecasting, but as it stacks up at the moment, it looks as though the job market is cooling, but cooling at a very modest rate. But I know these things can turn quite dramatically, so we have to be alert to that risk. We are in an interest rate regime that we consider restrictive, so any new financing, rolling over of financing, is going to be more punishing for the borrower. So there is a gradual tightening on the economy, and therefore gradual cooling of the labour markets. But I say, given the sort of growth initiative agenda of the administration that we're seeing, the health of the consumer, the balance sheet strength of the consumer, again, we would anticipate labour market cooling to maintain that only sort of modest pace. And therefore that would sort of support risk-taking in like the likes of equity markets and such.
All right, Ben, got to leave it there. Really great to get some time with you. That is Ben Gutteridge of Invesco. Meanwhile, I take a check on futures right now. About 20 minutes until the opening bell. You can see not too pretty out there. The S&P 500 down by about 0.1%, and it just gets worse as you go on. The NASDAQ 100 off by about 0.5%. It certainly doesn't help that NVIDIA is down about 1.6% right now, and the small caps taking a hit, with your Russell 2000 down by about 0.6%. Now, coming up, more on the single stock picture, because EA lowered its booking outlook, and you can see the stock is taking a bath right now. Details next. This is Bloomberg.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot with it. They just give you very superficial ideas, but at the end you still have to customize and have to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I feel that, when the designer doing, it's the spirit, it's the heart that the computer don't have.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Wednesday, the Fed decides.
The Federal Reserve has gone from projecting 4 cuts in 2025 to just 2.
The road may be bumpier than folks thought.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
How divorced can you say you are from the global market? How much can you talk about American exceptionalism?
This is not a snooze fest. There's a lot going on here.
Could not agree more.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
And now to high interest, a look at what's making headlines around the world. Saudi Prince Mohammed bin Salman told President Trump that he's willing to expand investments and trade with the U.S. by at least $600 billion. That's according to the kingdom's state-run news agency, and the commitment is large even by the standards of oil-rich Saudi Arabia. And the Pentagon is deploying 1,500 more troops to the southern border to comply with President Trump's declaration of a national emergency. Trump's acting defense secretary said he had also approved the use of military aircraft to assist with deportation flights of more than 5,000 illegal aliens detained by Customs and Border Protection. And a new study finds adults with ADHD, attention deficit hyperactivity disorder, are dying at an earlier age on average. Men with ADHD live 6.8 years less than the rest of the population, and that deficit grows to 8.6 years for women. That's according to an analysis of electronic health records from more than 300,000 people in the UK, Katie.
Well, let's make a hard pivot here and talk about video games, because we're watching shares of Electronic Arts this morning. The stock plunging after projecting weaker revenue from in-game purchases. EA pinned most of the blame on its soccer title, that is EA Sports FC 2025. That was released in September to mixed reviews, but Dragon Age also disappointed as well. Let's break it all down with Bloomberg's Jason Schreier, who covers the video game industry. And it seemed like sports helped Netflix out in a big way. Can't say the same thing for EA, though.
No, it was a rough year for EA's soccer title. Part of it is year-over-year comparisons. I was just reading a note from analyst Doug Kreutz at TD Cowen, who was saying that they appoint the decline to tough year-over-year comparisons and marketing spend. The marketing spend for this game was a lot bigger last year, but it's been a rough transition. EA recently got rid of the FIFA branding. They decided, hey, we don't want to pay FIFA anymore for this license to call our soccer games FIFA. And they switched to this kind of clumsy EA Sports FC title. And although last year's game seemed to perform well despite the name change, this year's did not.
Well, Jason, that was going to be my question just about this. Does that decision look like a mistake now in hindsight, given how prominent that FIFA branding was?
I don't know. I think it's still too early to tell. EA said in the prelim results last night that the big downturn here, the big hit here was in live service revenue. And what that means in kind of non-gobbledygook is the amount of money that players are spending after they buy the game. And the soccer series that they have is very contingent, the success of that. And a lot of the revenue that comes in from that is people not only buying the game, but also spending money on these kind of card packs and players that they can buy after they are already playing. And the fact that revenue is down, I believe it was an almost at least 10% swing, because they had estimated a mid-single digit growth, and instead they switched that to a single digit decline. The fact that that was such a plummet is bad news for them, and it remains to be seen if they can get that fixed in this game and then in next year's entry.
So that's the story on soccer. I do want to talk about Dragons, though, because you're right that Dragon Age, the Veilguard, that came out in October. It reached 1.5 million players during the quarter, but that was missing expectations by about 50%. What happened there, Jason?
Yeah, that's a huge hit. Not as significant as far as EA's overall financial picture as the sports game is, but still a pretty big hit. It's not often that games miss by 50% of expectations. I think there are a lot of factors here. The game itself was a little bit polarizing. It was a 10-year gap between this entry and the previous game, and so there might have been a lot of just kind of waned interest for the Dragon Age franchise. BioWare, the studio behind it, has had a string of critical misses. Its last two games, Anthem and Mass Effect Andromeda, were both critical and commercial flops, and the studio has really lost a lot of player trust as a result of that. But also, I mean, big picture-wise, the video game industry is facing some serious headwinds. A lot of people are not buying games, and there's some big picture, really interesting trends I've been watching for the last few years. Kind of the short version, one of the biggest reasons is, well, I'll just say Fortnite and games like it, because a lot of people are just playing the same games that they've been playing for the past 5, 6, 7 years, and they're not buying new ones. So that has been a big factor as far as players spending. Holiday season, big new titles are not getting the same kind of market saturation.
It's great context. I also want to do some analysis with you here, inter-industry, because if you look at EA, for example, versus Take-Two, over 1 year, you have a stock price appreciation of EA of less than 7%. That's more than 14% of Take-Two. Of course, both lag the S&P 500, but you do see divergence there. And if you did it over 5 years, it's actually worse, that disparity. So what are EA's rivals doing that it's not?
You know, Take-Two is in a different sphere of existence, because GTA 6, which is Take-Two's game that is currently announced for fall of this year, although I wouldn't be surprised if it slips, that is going to be the biggest thing on the planet. That might be analysts and pundits and journalists like myself are expecting that to be one of the biggest entertainment launches, if not the biggest entertainment launch of all time. So all of Take-Two's trading and pricing, it is all just almost entirely based on when people expect that game, how people expect that game to do. It's going to be earth-shattering for the video game industry, and a lot of other companies are looking to that to kind of rise all tides and get a lot more people playing in general, and hopefully boost the health of the industry. So I don't think you can really make a one-to-one comparison. EA is a lot more dependent on their kind of regular meat and potatoes franchises, including the sports franchise, and I think it's a really big red flag. I would certainly be worried if I were in Redwood City right now about that underperformance of the EA. Man, I still say FIFA, the EA Sports FC. It really is a mouthful. EA Sports FC title.
Yeah, say that 5 times fast. Jason, we have less than a minute left, and I have a little bit of a wild card for you. Did you see that Elon Musk online admitted that he had some help reaching the top levels of games such as Diablo TV and Path of Exile 2? I'm just wondering what the reaction to that has been.
I did see that. I mean, nobody's shocked, because he claimed to be one of the best players in the world and has spent like thousands of hours playing these, while he's also running 6 companies and flying to Mar-a-Lago every day. So it seemed unlikely. What I'm curious about is, would a company like Blizzard, which runs Diablo, risk banning his account? Because technically that is against the rules. You should be banned if you're if you're paying people to run your account for you. That is not allowed. So I wonder if companies will risk the wrath of Elon Musk by banning him from their games.
Yeah, that would certainly be a political statement at this juncture. Jason, great stuff. Really great to get some time with you. That is Bloomberg's Jason Schreier. Jason, of course, is also the author of the book Play Nice: The Rise, Fall, and Future of Blizzard Entertainment. Now, coming up, American Airlines tumbles after forecasting a surprise first quarter loss. We'll dig into those results later this hour. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Welcome back to Open Interest. Let's take the pulse of these futures. Of course, minutes away from that opening bell. We're coming off of 3 straight days of gains. We almost hit record highs yesterday on the S&P 500. And what goes up must come down at least a little bit. The S&P 500 down about 0.1%. The NASDAQ 100 down 0.5%. We do see some pain in the chip sector right now. You can see that weighing on your big tech benchmark. The small caps, we have a slight rise in Treasury yield. We're back above 460 when it comes to that 10-year benchmark Treasury yield. And as such, the Russell 2000 down about 0.6%. It feels like we've taken our eyes off the bond market a little bit this week, of course, with President Trump taking office back again. I wonder, of course, as we head into Fed week next week, whether that's going to become the conversation again.
Time to bring it back. We're at 465 nearly. It's not too much of a move today, but over 2 days, you're up more than 7 basis points on the 10-year. You're now at 430 on the 2-year as well, so even a little bit of a lift on the shorter end of the curve. And to your point, small caps underperforming because of it. Another interesting thing about the small caps is those small businesses are where all the excitement is in the Trump administration, not just because of where, or despite rather, where yields are going, but what happens with tax cuts? Is that really going to help the small business sector?
Also tariffs, too. The idea is out there that, of course, as manufacturing and spending power shifts domestically, that'll help some of these small companies that really don't have that international exposures. There's all these great bull cases out there, and it's just not necessarily translating through into the stock market, but we'll have to see.
How much you hear the dollar word is what I wonder in the next set of earnings. Now, coming up, we're less than 4 minutes to the opening bell. We're going to discuss the moves with Ethan Devitt of Moneta. She's the Chief Global Market Strategist there. Don't miss it. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
There is this real momentum from Wall Street.
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
All right, we are moments away from the start of trading, about 20 seconds to be exact. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. This time yesterday, of course, we were talking about all that enthusiasm in the markets, in big tech, over that AI pact that was shepherded by Donald Trump, $100 billion of investment. Now you're seeing some of that euphoria fade a little bit. We got some reality checks on the earnings front, of course. We have a blackout when it comes to Fed speak. So we're looking for the next catalyst right now. You can see, though, at the two stock exchanges, people are clapping. There's a lot of excitement down there. But if you switch up the board and take a look at how we're doing in the first few seconds of trading, it's none too pretty. You're seeing yesterday's action, of course, right now. And you had that big rally in the NASDAQ 100. It's faded and then some today. The NASDAQ 100 down about 0.5%, 0.5% if you want to be fancy. Of course, the chip makers in the hurt locker a little bit today. The S&P 500 faring a little bit better here, down by only 0.1%. There's a lot of daylight between now and 4 p.m., so we'll keep a close eye on that one. But the Russell 2000 also seeing some pain this morning, down about 0.5%. We are seeing that slight rise in bond yields. We're back above 4.60 on the 10-year Treasury yield. A quiet climb, but making itself known in the small caps. Let's take a look under the hood here. I mentioned those disappointing earnings, and you can see that in American Airlines. Lower after unexpectedly forecasting a first quarter loss. That's in contrast to the more bullish outlooks we've seen from rival airlines in the past few weeks, and you can see that surprise in shares right now, currently down by almost 9%, Shanali.
We'll dive more into that one. Serious surprise there. Electronics Arts, even a bigger surprise. You're watching it down more than 16% as the market opens. The video game company's missing forecasts after two of their most recent games failed to meet expectations. Tough blow in what has otherwise been an exuberant earnings season. But also looking at chip stocks falling. If we flip up the board here, results from Korean memory chip maker SK Hynix failed to impress. And it's bringing down NVIDIA, Micron, and ARM to the tune of 1.8% for NVIDIA. Micron down even more than 4%, and ARM down 5.9% nearly, Katie.
All right, let's broaden out this conversation now with Ethan Devitt. She is Moneda's Chief Global Market Strategist, joining us now. And Ethan, it's day 4 of Donald Trump's second administration. We've seen a lot of action when it comes to immigration, AI, tariffs. We've heard JP Morgan is setting up war rooms to examine all these executive orders that are coming through. How are you separating the noise from the actual signals here?
That's a great question. You said it. There has been a lot of action, this flooding of the zone of all kinds of executive orders, tariffs one day, no tariffs the next, or a more lenient attitude to tariffs one day. It's actually a lot to digest, and markets abhor uncertainty. And as you can see with this on again, off again risk sentiment, it's been a very difficult market to navigate. And we do know that a lot was priced in, and we certainly thought this was dollar dominance. That was the code word of last week, pre-inauguration. And now we're actually seeing some dollar give back, as it does seem that not every trading partner is essentially a sitting duck for whatever trading policy the U.S. wants to impose. So there is a sense that perhaps we maybe oversimplified the situation going into the new administration. So quite a lot to digest this week.
The on again, off again risk appetite out there seems to be a difficult thing for a lot of investors to navigate, as you had mentioned. The S&P 500 yesterday closed less than 5 points away from a record high. And today you're watching that risk off moment once again. What would cause you? What do you need to see definitively to be risk on once again?
We need to see clarity around regulatory change, around tariffs, around perhaps working with the Federal Reserve in terms of knowing that they will be mutually supportive in terms of the administration. There won't be rhetoric against them, because that's exactly what the Federal Reserve has worked so hard to do over the last 18 months, is to restore its reputation, to be very clear, very data dependent, and have no surprises. So in order to be firmly risk on, we need to know that many of these concerns, which are keeping investors up at night regarding inflation, the direction of the Fed, what's going to happen with tariffs, what that would do to the U.S. economy, all of that needs to be put to bed a little. And all we need for that is clarity.
Clarity. Let's layer that conversation and that need for clarity on top of the earnings picture that we're getting so far. It's early yet, but you think about Electronic Arts sinking by 18% at one point. That is the biggest drop since 2008. You also have American Airlines having a pretty painful morning as well. Is that a little preview of what to expect when we get deeper into earnings season, that if you miss, you're going to be punished in this market?
Absolutely. You named two sectors there, and we've seen a very similar sell-off, and we saw that in the obesity drug sector as well. So it's a very sharp sell-off, a sudden disgust perhaps, or a sudden concern around the frothiness. That is a symbol that markets are on edge and waiting perhaps for something to tip over. And we've seen that in certain sector by sector. Similarly, there will be differentiation within sectors. So that could be a good market for active stock pickers. They've been claiming that this is a good stock picking market for some time now. We haven't exactly seen that. It's all been about the index shares, and we've seen flows out of active managers as a result. But I do think that more differentiation is likely, but clearly no sector will be immune.
When you think about what we're going to see next week with the big tech earnings as well, how do you expect them to perform, especially after such a big run-up? If Netflix was just a taste of outperformance, do you think the others can live up to the hype?
I think we have to put all this in context. Let's look at the inauguration at the beginning of the week. We saw this astonishing display of the tech titans side by side with the highest order of politicians. And we know that they have firmly a place at the table. They're optimistic. They are reining in some of their policies that didn't concur with the Trump administration's policies. And they're poised for exciting 4 years ahead. So I do not see anything. I think we know that they've been telegraphing earnings well in advance. We know they have the margins to justify it. We know they have the pricing power. And if there's uncertainty around regulatory developments, possibly around the regulatory eye that's on tech companies, again, we hardly heard anything about that in the executive orders. So I'd say they're feeling pretty optimistic at this point. Now, what we've seen in the chip stocks this week is a concern that perhaps too much has been baked into these prices. But I would say the tech companies are probably ones not to bet against at this juncture.
That's interesting. And I want to wrap that into the political landscape as well, because you think about Monday's inauguration, you had all the big tech CEOs there in a prominent way. I mean, you think about this antitrust, this regulatory overhang that has really clouded a lot of these big tech names. As an investor, how do you read the fact that you do have these tech CEOs seemingly cozying up to Trump? Does that matter to you, or is that something that maybe is more towards the fringes?
It matters in a very positive way, I'd say, just in terms of why are they doing this? They're doing this to clearly align their interests with those of the new administration. They want no surprises. They want to be inside the tent. And being inside the tent, I think, assures that there will not be negative or perhaps politically motivated attacks on their positioning. maybe no attempts to unbundle. I think it's very shrewd tactics on their part to get inside the tent. I'd say as an investor, you feel safer that way because you know there will not be a targeted, perhaps, regulatory change. And I'd say now it's about closely watching just how well this marriage works out because it is a new one. It's a new set of chemistry, certainly a change from the first administration. And we've already seen with Doge that one of those leaders is gone. So there will be friction. These are big egos at play, a tendency to be competitive. We know that from the space race that we saw quite recently. So I'd say watch this space.
We're going to hold that thought on Doge, talk more about it later in the show.
I cannot wait, I have to say. That'll be fun.
It's been a lot of news, when you look at the Russell 2000, that's another thing Katie and I have been talking a lot about. You look at it from the November heights, and it's down almost 6% already. Part of that was fears around what you saw in terms of interest rates. On the longer end of the curve, a lot of these firms have a lot of debt. As we know, many of them are unprofitable. But this has been a big trade. This has been a hopeful trade, and it's been a trade that's been expected to do well under the Trump administration. Would you buy this dip, or do you think that there's still uncertainty in terms of performance there?
I would buy the dip, yes, because I do think it's been overdone. And also, we need to rebalance our equity portfolios at all times. So we still believe in a balanced equity portfolio between large and mid-cap and small cap, as well as also non-US and US. So we're still somewhat traditional in that respect. But I would say in terms of what's driving it, we can see that there is an expectation that America first would be good for those that are not dependent on international trade, that are not affected by a strong dollar, and perhaps don't have as much leverage. So we're not going to be subject to needing to refinance even at these still higher interest rate levels. So a lot was tailwinds in terms of small and mid cap, but they've just failed to deliver according to expectations. We still see a lot of the momentum behind large cap tech. As I mentioned, that's now almost a risk-off trade in equities is to be large cap tech, even though it's volatile, even though it's well priced. And as I mentioned, the fundamentals support that. There's a little bit of reticence around buying into mid-cap at the moment. It has been trailing. It's a more defensive type of sector. So I would say, yeah, yes, but in terms of whether I would buy in the dip.
All right, and to that point, I mean, you take a look at, it's early yet, Shanali, but the NASDAQ 100 outperforming, the Russell 2000 underperforming. It's a story we're pretty used to at this point.
We've been so used to it, and you have to wonder whether the earnings season can give investors something else to chew on. Bloomberg Intelligence, just reading this morning, said that they think healthcare is going to outperform. I know that's been a really exciting sector that you've been digging right into.
Yeah, and DataTrack, to that point, one of our favorite research shops out there, saying it's too cheap to ignore, but Ethan, we got to leave it there. Great to speak with you. That is Ethan Devitt of Moneta. Now, coming up, airlines on the up and up, except for American, that is. More on that next. This is Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back to Open Interest. You take a look at the stock market right now. Not too much change to report. The S&P 500 down about 0.1%. A lot of that weakness being led by what you're seeing in big tech right now. The losses coming back a little bit. The NASDAQ 100 down about 0.4% right now, and it's a similar story if you take a look at the Russell 2000 down about 0.4% as well. We'll continue to track the movement there, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, Boston Beer downgraded from overweight to neutral over at Piper Sandler. The analyst citing slower than expected sales growth of Twisted Tea. Next up, healthcare software Viva double downgraded over at Goldman Sachs from buy to sell. The analyst cites competition from Salesforce and says that a fundamental recovery in the life sciences vertical is likely to be slow. Shares currently off about 4.5%. And finally, we have Netflix upgraded at Wolfe Research after its strong earnings report. The analyst says that the outlook buried long-standing concerns about a deep slowdown at Netflix, adding another 2.3%, Shonali.
And in earnings news, we've been talking about it all morning because it's seeing a pretty strong dip here in the market. American Airlines forecast is a surprise first quarter loss, and it's bridged from rival carriers that have been cashing in on unusually strong winter demand and pricier domestic fares. By contrast, Alaska Air forecasts a smaller than expected loss in the first quarter, and GE Aerospace announced a $7 billion stock buyback after topping profit estimates. You can see the dispersion there in all the stock prices. And joining us now to unpack it all, George Ferguson, Bloomberg Intelligence's senior aerospace, defense, and airlines analyst. Want to just go right into what's going on with American Airlines, because of course there's today's story. You're seeing the stock really fall the most here intraday since May of last year. They have underperformed their rivals generally, and you do have analysts weighing in, citing concerns about costs outside of fuel, in addition to other missteps in the recent quarter. What would you look into most in terms of what's going to matter for them in the year ahead?
Yeah, so I mean, I would start by saying I thought they had a really good quarter, right? And their revenue performance was as good as, if not better, than their peers, United and Delta. And look, I mean, I think, you know, there's only 3 big full-service carriers in the U.S., and American made a misstep by trying to do a lot more direct bookings than, you know, getting through travel agencies. They've changed that, switched back to taking more travel agency bookings. And, you know, I think you can expect that they're going to catch up, right? It's not like United and Delta are going to be able to run away with the business. Now, for 1Q, they're going to put less capacity into the marketplace. They just signed another labor agreement that's going to increase costs. So their costs are rising high single digits, where you've got United and Delta rising mid-single digits. Look, you know, they said by the back end of the year, 2025, you know, they'll lay in more capacity and they'll get those cost increases down to mid to low single digits. They'll perform probably as well as United and Delta. Again, they've got ground to make. They've been the underperformer. They've got ground to cover to get there. But I think that you'll continue to see them close that gap. Right? I don't think, again, United and Delta are going to walk away with this business.
That's really interesting, George. It sounds like what you're saying is basically this 9.3% plunge that we're seeing in American right now is a bit of an overreaction.
I think so. I do think so. Again, one Q is going to look worse than the other two, but I still think they're all three working in the same marketplace. They have very similar, routes and regions they fly to. It's going to be really hard again, I think, for American not to be able to catch up to rivals.
I also want to go to GE with you for a moment here, George, because you are looking at just a stunning capital return story in addition to what has been a very high-performing stock. In the past year, you're looking at shares up about 8.6% right now as well. How much juice do they have to really still take out of this performance story? What does the year ahead look like for them?
You know, the delays in new aircraft deliveries from Boeing and Airbus have really sort of driven in the marketplace the need to fly older airplanes longer. And GE and the other engine makers, but remember, GE is the biggest and the best engine maker globally. They have really strong market share in narrow-body aircraft and wide-body aircraft, unlike their rivals. So they are really benefiting from this desire to fly planes longer, and therefore you need to maintain those airplanes. That maintenance business is very large margin business, and so I think it'll be a tailwind into the next year, into 2025 for sure. I think it starts to tail off into sort of 26s, 27 timeframes, but really long, these are long trends in this business. And so GE is really generating some great cash and really nice margins right now.
George, we thank you so much for your time and analysis. A lot of news in your sector this morning. That is George Ferguson from Bloomberg Intelligence. Now coming up, Elon Musk takes sole control over Doge as Vivek Ramaswamy exits. And we're going to look at the future of the department in our Wall Street Beat next. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's time now for the Wall Street Beat. Today we're looking at the divorce between Elon Musk and Vivek Ramaswamy as it pertains to Doge. For more here, we are joined by Max Chafkin of Bloomberg, follows Elon Musk closely, and people out, people in. I'm also looking at this story this morning in the Wall Street Journal. Michael Grimes, who's a star banker at Morgan Stanley in the technology industry, big part of taking Tesla public, big part of Elon Musk buying X, might leave Morgan Stanley, go to Doge. Are they going to pay him?
I mean, look, if you're a deal maker, this is where all the deal guys are right now. So it makes sense in that way. I don't know. There are definitely a lot of sort of big names who are close to Elon Musk, sort of friends of Elon, who are providing, informal advice. Reading the Wall Street Journal's report, this sounds like
Mark
potentially
Andreessen.
a more formal role. Yeah, Mark Andreessen and David Sachs and others. So on the other hand, we're also seeing Vivek Ramaswamy, essentially out at Doge and running for governor. So it's a bit of a revolving door right now.
So two things. One, it's confusing that his name is Michael Grimes and not Grimes, the musical artist, who, of course, has given birth to several of Elon Musk's children.
He likes the Grimes.
That's true. That's true. It's an appealing name for him. Number two, when we say a job at Doge, is it really a job with a paycheck, or is it sort of on a volunteer basis?
There have been conflicting reports, even conflicting reports from Elon Musk and Doge. Initially, Elon Musk said it's going to be volunteer, you're going to have to work 80 hours a week. Doge, the Twitter account, which may or may not be an official government Twitter account at this point, has also listed actual jobs, it appears, in HR and finance and things like that. So my supposition is that there are going to be some people who are actually paid, but a pretty small number. It is a government efficiency commission, after all, as well as a healthy sort of group chat. I mean, it seems like a lot of what Doge is, I mean, some of Doge is inside the government. Some of it is this kind of almost like political advocacy group, with Elon Musk's Twitter at the head, advocating for essentially Donald Trump's policies.
So if we look on average, just days into the administration, is Musk now closer or less close to Trump, given what he's doing with Doge? Because this was supposed to be an external body, not an internal government body from the beginning. At least that's what Ramaswamy wanted, according to the Journal.
Yeah, I mean, the conventional wisdom all along is like these guys their egos are too big, they won't be able to last. And that is not what we've seen in any way. Musk, according to reports, is working out of the West Wing right now. He was in the Oval Office when Trump pardoned Russ Ulbricht, the crypto-convicted Silk Road founder. So he is very close. There is no sign that they are falling out or anything like that. Although Musk is giving Trump plenty of reasons to potentially push him aside if he ever wanted to.
Well, let's talk about AI, and that AI JV that was announced yesterday or 2 days ago with the $100 billion of investment coming from SoftBank and OpenAI involvement as well. Sam Altman, Elon Musk famously don't get along. When we think about the future of the relationship between Musk and Trump, could this be a potential breaking point?
Possibly. If we were talking about this AI announcement, we would be saying, critics are saying that this $100 million or $100 billion or potentially $500 billion thing is just a marketing thing and they're never going to fund it. It's not going to create any jobs. Turned out yesterday, one of those critics was Elon Musk, who spent about half the day calling Sam Altman, quote, a swindler, calling the announcement, quote, fake, posting all of these tweets from, years ago where Sam Altman had supported Democrats, really undermining, President Trump's big infrastructure announcement in a way that felt kind of extraordinary, just given the fact that Elon Musk is in the administration.
Yeah.
And of course, as you say, Katie, that is the feud with Elon Musk and Sam Altman, which goes back all the way to the founding of OpenAI, the creator of ChatGPT. It goes all the way back to the founding. They are in litigation together. So I don't know. We're going to see this continue.
I do wonder if it means that Trump's relationship to Sam Altman, therefore, is going to become closer and closer, and whether that spells a little bit of trouble for Satya Nadella, who was not in yesterday's announcement.
I mean, one thing I'll say is Elon Musk has a point. Like, it is not clear that this $100 billion or $500 billion is there.
Right.
And you are right. There is potentially, I suppose, a threat here to Microsoft. Although, again, it's not clear how much money is really behind this. So how big a threat, I don't think we know yet.
Well, it's really fun comparing who's in, who's out, how that might change. Max Chafkin, fantastic reporting as always. Meanwhile, a quick check on stocks. We're just about half an hour into the session. You can see the S&P 500 still down. Similar story across the indexes. Stick with us. We'll talk to Liz Ann Saunders of Charles Schwab Investments next. This is Bloomberg.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. The envelope, please. The Oscar nominations announced in Los Angeles last hour, and Emilia Perez, about a transgender drug lord, leads the pack with 13, including a nod for Best Picture. CBS Entertainment reporter Matt Wolf.
Emilia Perez was the little film that could, right? It's avant-garde. It's gorgeously shot. It's got a blazing soundtrack, too, and it's got this super compelling, timely sort of story.
Another musical, Wicked, and The Brutalist get 10 nominations each.
Welcome to America.
Among the snubs, Denzel Washington for Gladiator 2, Nicole Kidman, Baby Girl, and Conclave's director, Edgar Berger. The awards will be handed out in Los Angeles on March 2nd. A new wildfire exploded overnight north of L.A. Correspondent Jonathan Vigliotti is in Castaic.
While some residents armed themselves with garden hoses, others were wasting no time in leaving.
It's pretty scary, and I'm not going to take the risk. I'm going.
Idania Perez is one of more than 30,000 residents ordered to evacuate.
My brother just lost his home over in Altadena fire, and now I'm like, oh, my God.
A federal court in Seattle is set to hear the first legal challenge to President Trump's executive action on birthright citizenship today. Berkeley Law's Erwin Chemerinsky.
The judge is bound by Supreme Court precedent, even though it's one from 1898. So I would expect the judge to rule very quickly and to rule against the Trump administration issuing a preliminary injunction.
An update on the 7 San Antonio police officers shot when they responded to a possible suicide call. KENS TV's Sarah Duran.
The suspect, a man in his 40s, has been confirmed dead. 7 SAPD officers are in the hospital this morning. 4 of them have non-life-threatening injuries, but the 3 others we are still unsure of.
Ford is recalling more than 250,000 SUVs and trucks because of defects. WWJ's Jeff Gilbert.
It's a defect in the manufacturing of the 12-volt batteries in certain 21 through 23 Bronco Sports and Mavericks. While this is a safety concern, Ford has no reports of fires, accidents, or injuries. Dealers will inspect the vehicles and, if needed, replace the batteries.
5 NFL stars are in the running for the AP's Most Valuable Player Award.
There goes Berkeley into the clear, through the snow, all the way home.
Saquon Barkley, Josh Allen, Joe Burrow, Jared Goff, and Lamar Jackson, all finalists. Burrow is also in the running for Comeback Player of the Year. Winners will be announced February 6th. This is CBS News.
With ZipRecruiter.
A man upset about the TikTok ban is accused of a violent protest. Reporter Bruce Marcus from Wisconsin.
A 19-year-old man is facing several charges related to a fire he allegedly started over the TikTok ban. Caden Stakowitz is accused of setting fire to an office of Congressman Glenn Grothman, who voted for the ban. Stakowitz reportedly told police he planned the fire, bought gasoline near his home, and then drove 40 minutes to the congressman's Fond du Lac office. The incident caused no injuries and did no major damage.
Sure pays to work at Walmart these days, at least in management. The Wall Street Journal says the company is raising pay for top regional store managers to more than $600,000 a year with bonuses. Walmart's also reportedly cutting perks for office-based workers, including ending remote work and shifting to less generous health insurance plans. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well. So go to YouTube, search Bloomberg Podcast Live. That's the quickest way to find us. Alex Steele and Paul Sweeney. We are in our New York City headquarters. John Tucker joins us as well. Here's what we're doing over the next 2 hours. The next hour, the first hour here, we're going to have a lot of good guests talking about market-moving events. And then in the second hour, the 11 o'clock hour, we're scheduled to take President Donald Trump. He is scheduled to deliver a address to the assembled group in Davos, Switzerland, virtually, and we will bring that to you when that starts in the 11 o'clock hour. So we've got a lot coming up, and we've got kind of a mixed looking at the market here. We've got the S&P down a couple of points, the Dow up a little bit, NASDAQ down a little bit, so not a lot of direction here. But let's check in with John Tucker, get a Bloomberg Business Flash. John.
All right, Paul and Alex, this Bloomberg Business Flash being brought to you by IBKR. Will U.S. oil production exceed 13.61 million barrels per day for November 2024? Well, you can trade your prediction at Interactive Brokers. Buy yes if you agree, no if you don't. The correct answer is earn $1. Go to ibkr.com/forecast. Well, it's the global chip makers that are in the news this morning. Those shares lower. This is after South Korea's chip maker, SK Hynix, delivered record quarterly results, but they failed to impress. As a result, you have others like NVIDIA right now. That's down 1.4%. ASML Holding, they were down as much as 4%. GE Aerospace shares jumping after reporting adjusted earnings per share for the fourth quarter, top Wall Street expectations. They also announced a buyback of $7 billion worth of stock. GE shares 8% higher. You also had American Airlines sliding after forecasting a surprise first quarter loss. And right now, the biggest loss in the S&P 500 individual stock, that belongs to Electronic Arts. Those shares are down over 18%. The video game maker warned of slowing demand for its soccer-related titles. Well, as the Federal Reserve prepares to meet next week, Sarah Wolf at Morgan Stanley, she says tariffs will be front and center for policymakers.
So the Fed might be in a position where they're going to have to take cuts off if that's the case, or not cut at all, and kind of be on hold until they see all the tariffs play out and what it means for economic activity.
Well, the number of Americans on the benefit rolls climbing to a more than 3-year high. And then there's this one. Warner Brothers Discovery's CNN division letting go of 6% of its workforce. That's about 200 employees today. The cable news network focusing on streaming and digital audiences amid declining ratings after the election. S&P 500, 5 points lower right now, 6,080. The NASDAQ 100 is down 0.5%, down 112 points. The Dow Jones Industrial Average up 112 points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and That's your Bloomberg Business Flash. Paul and Alex.
All right. Thanks so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. As Paul said, listen to us. Also watch us on youtube.com/Bloomberg Live. You can check us out there. Let's get more information here on some of the stocks because Electronic Arts was so interesting. I thought that like football, soccer, games were like all the rage. So the decline in sales in the pre-announcement was pretty staggering to me. Isabel Lee is a Bloomberg cross-asset reporter, and she joins us now. What was your take on EA?
This was interesting because you see that Netflix really gained a lot from sports, but then it doesn't look the same for EA. And then they said bookings fell in the third quarter, so they missed estimates. The publisher also produced projected bookings within a range of $7 billion to $7.15 billion. That's lower than previous guidance. And you see the stock sinking 25%. That's the biggest drop since 2008. And even Wall Street banks really aren't happy. BMO Capital said that the results imply a meaningful miss. Raymond James said the magnitude of the shortfall is concerning. And Morgan Stanley said the pre-announced figures were disappointing. So really,
the
everyone
gaming
isn't
business,
happy.
I've always viewed the gaming business as kind of like the movie business. It really is hit or miss. You have to have the importance of franchises. And EA has a lot of franchises, but this is just a classic example. We see it. It's not too rare that we see big moves for these.
But you would have thought that the FC franchise, the FC Ultimate Team franchise, is a good franchise for them.
Yeah,
so I
and
wonder
I think
what is changing.
Right, I think that's kind of what surprised everybody here. Like, I thought we were paying a big multiple for this franchise and other franchises. So there you go.
Exactly. All right, Oracle. Are we still up here? It's been like what, 6-7 days?
It's flat now, up-ish, but it basically charged out of the gate in 2025. It saw its best year in a quarter of a century. So the stock is up more than 10% in January alone, and it posted a nearly 60% gain last year. So of course, we know big news here. There was news yesterday that there will be a $100 billion joint venture with SoftBank and OpenAI to really fund an expansion of data centers. And Oracle is a small player in the cloud computing space. It really lags behind the big three, just Amazon, Microsoft, and Alphabet. So the joint venture has a goal of growing at least $500 billion. But of course, as with everything, there are questions. We have Elon Musk publicly questioning whether the companies could follow through. Anthropic CEO said that the project seemed, quote, a bit chaotic. So I don't know if that's really supportive of what was announced, but there's a big push there, and stock is reacting.
It's the first time I've seen Elon Musk kind of break a little bit from.
I agree with you.
But
he doesn't like OpenAI.
Well, again, there's probably a lot of things he doesn't like, but that's not impacted his. It'll be interesting to see. I've always, when I looked at Elon Musk-Donald Trump relationship, I'm measuring it in weeks, not months or years.
Right.
So
Well,
we'll
I think that's a big question. How do you measure it? Is it the disagreement, or is it when he appears on the front of the Time magazine?
Well, yeah, Steve
Puppeteer of the year.
Yes.
Right, which is a really good example.
Yeah, so that'll be interesting to watch that dynamic.
It'll be the world's messiest breakup, they said. But he has a White House email now, so.
Oh,
yes.
As many do.
Yes.
And it depends on how long you keep. Before you go, Intel, what's going on here? Stock down almost 2%.
Yes, and that really comes after it was downgraded by HSBC. HSBC said that the stock is now fairly priced, having priced in the recent uncertainties. So it said that the execution of IDM 2.0 strategy, as well as the management attrition with the CEO resigning, is already priced in. So what is this strategy? It's basically expanding manufacturing, increasing innovation, and working more closely with other semi companies. So the stock is down nearly 40% from its July peak, but HSBC sees limited downside. So there's that. The worst is over for Intel, they say. And remember, we had news last week that Intel is an acquisition target. There was the newsletter, semi-accurate, saying that a company is trying to acquire Intel and that this mystery company can afford to acquire it as a whole. Remains to be seen, though. Intel has really lagged.
It's got a market cap of $92 billion. You put a takeover premium on that.
Who can acquire that?
Yeah, I don't know.
You break it up for pieces? Like, what does it have to do in order to get it cleaned up? Anyway.
Yep.
All right, Isabel, thanks a lot. Isabel Lee, Bloomberg cross-asset reporter, joining us on All the Movers. Okay, we are also, of course, looking ahead to Davos, as President Trump will be addressing the Davos participants there, as well being questioned by 5 CEOs. Nathan Dean is Bloomberg Intelligence Senior Policy Analyst. All right, Nathan, what do you think his goal is, and what do you think the audience's goal is here?
Yeah, so, I think the audience's goal here is to try and find out, are we going to get a confrontational President Trump or a negotiation President Trump when it comes to things like tariffs and America first? President Trump is going into this speech with essentially to lay the land of his vision. And it's important for investors to remember is that the power of the presidency is more powerful when it comes to these national security, trade, and tariff and geopolitical arguments. And presidents in their second term generally spend more time focused on outside the United States than within it. So what I'm hearing or what I'm expecting from this speech, what I want to hear is this language over tariffs. I think it's going to certainly come up, but is he going to signal that I'm going to confront, meaning, am I putting in a tariff on February 1st? Or is he going to use language like, oh yeah, this is definitely coming, but I'm just making this up. But I think the Wall Street folks and the folks over in Davos really want to hear that negotiation Trump, because it signals that threats aren't immediate, and obviously it's always subject to a negotiation and may never actually take place.
Is this a forum for him to opine at all on Ukraine, do you think?
Yeah, I certainly think the Davos folks want to hear this. And, from us on our side, on the investing side, we saw President Trump put out his statement on Truth Social to President Putin saying, end this war now. And if you don't, then I'm going to slap you with sanctions and tariffs and so forth. Now, I think a lot of folks are anticipating that President Trump will negotiate with President Putin. If you remember, before the inauguration, he even said that they were going to try and set up a time for them to talk about this. But I think you want to see what the steps are and whether or not President Trump will try and confront President Putin, or is he going to signal that we're going to talk about it? From the sanctions standpoint, it's important to remember for those of us that if it's a congressional sanction, President Trump really doesn't have the ability to go back and overturn that. You need to go back to Congress. If it's presidential sanction, that's a little bit different, but there is a law in place that would require President Trump to notify Congress before doing that. Where I'm going with this is that if there's any amount of sanctions being lifted, we should get noticed well in advance of it happening.
You said, what, confrontational or negotiator? Was that the term you used?
Exactly. Whether or not President Trump is going to come out and say, look, these tariffs are coming February 1st, or is he coming out and saying, well, I was thinking about it, but, maybe we're going to do it next week. We'll see. We'll see what happens.
Yeah.
He says that a lot.
No, I'm definitely into it. I'm just stealing it from you. That's why I needed to make sure it was accurate as I wrote it down. I guess my other question is, when we're booking out our 3 p.m. show, for example, I'll give you a little glimpse behind how the sausage is made. We're like, well, we got to do politics. And we're like, well, what's President Trump doing today? It's like, oh, well, he's talking at 11. What else is he going to do? We don't know, but we know there's going to be news. So what else can we expect in the next 5 hours?
Well, I think there's a lot of talk about, obviously, this, but then we're also trying to figure out what's going on with the confirmation hearings back home. I mean, Senator Rubio is now Secretary of State Rubio, but we still need Scott Bessent to be the next Secretary of the Treasury. We need to get that confirmation in place. And because, even though I just said the presidents tend to spend more of their time in the second term outside of the United States than within it, we still have a lot of stuff that's happening here at home. Not only do we have this tariff argument, but we also have congressional leadership going to the White House to meet with President Trump on this idea of this tax extension bill, this $4.6 trillion. Representative Lawler was there just yesterday talking about the SALT conference, or the SALT deduction, and even said, I'm not going to support a bill unless it has some type of SALT relief. So President Trump's giving this speech to abroad, and he toyed with the idea of even going there. But as soon as that speech is over, his attention is going to turn back to Congress. And just yesterday, he said that he was inkling towards meeting every single member of the Republican caucus at the House of Representatives, AKA I took that to be, I know I need every single vote, so I'm going to look each person in the eye and say, are you going to derail my agenda, or are you going to help me on this? President Trump's certainly getting a lot more involved in the House of Representatives than other presidents have.
All right, Nathan, great stuff. We always love checking in with you to get the update. I think we're going to be doing this a lot more over the next 4 years than maybe we did over the last 4 years. Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence. He is our go-to voice on what is happening in the halls of Congress and how it impacts markets. He joins us from Washington, D.C. Coming up, we're going to check in with Danielle Bokov, Bloomberg Green Senior Reporter. Big take story today, L.A. wildfires strain the world's firefighting arsenal. And Michael McKee, Bloomberg International Economics and Policy Correspondent, who'll get his thoughts on some of this economic data we had today. We're going to get some more later on this week. What is the Fed to do in terms of some of this economic data? That's all coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
I'm John Tucker, the Bloomberg News with this Bloomberg Business Flash. It is being brought to you by Oracle. Attention growing businesses, Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. This offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Right now, the major indexes, I'm going to call it mixed. S&P 500, 6 points lower. That's down 0.1% at 60.79. The record is, 60.90. So we kind of flirted with that yesterday. Dow Jones Industrial Average, 89 points higher. That's up 0.2%. The NASDAQ 100, 106 points lower, and that is down 0.5%. GE Aerospace, let's start from the worst, first to the worst. GE Aerospace up 8% higher. The biggest gain in the S&P 500. They reported stronger profit for the latest quarter than analysts expected. The company, which of course was split off from General Electric with two other companies last year, they say orders for the airplane engines and services jumped 50% from a year earlier to $12.9 billion. And then the worst performing stock in the S&P 500, video game maker Electronic Arts, dropping 17%. It said it's seeing a slowdown in revenue related to the soccer game they produce. Also said 50% fewer players played its Dragon Age game. I have no idea what that is during the latest quarter. On the economic data front today, we got U.S. workers applying for unemployment benefits last week, more than economists expected. Recurring jobless claims, in fact, at the highest in 3 years. Oh, yeah, Tom Brady considering the sale of his mansion on Florida's Indian Creek Island. There's no official listing, but it's a newly finished house, apparently. It's already received bids that value it at more than $150 million. Folks, this is a 2-acre lot.
That's small.
You want to offer me 150? I can be out in 10 minutes. Keep the kids.
I don't know.
You can keep the furniture.
The Jersey Shore is nice, John, but it's not this, billionaires row in Miami.
Also,
but I'm on a hill. I'm not going to get hit by a hurricane.
You're right.
It's
Tom
true,
Brady's house.
but you're not Tom Brady. I mean, I love you, but I'm just... So, I mean, he looks so surprised.
What are you saying?
I'm just saying, you're not Tom Brady. No. You don't get to say I'm in Tom Brady's house. Okay, let's get back to the news, and particularly what's happening in the LA wildfires. Of course, new fires crop up. It's super dry, and then the firefighters have to find ways to continue to fight them. Danielle Bokov is Bloomberg Green senior reporter, and she's responsible for the Big Take, talking about these LA wildfires. Danielle, can you just walk us through first how you fight a wildfire? Like, what are all the components? And then we can kind of get into, do we have enough of those components?
I mean, there's a huge range, right? We've done a lot of research on this in the last year because climate change is making such severe fires around the world, and they're getting trickier. In general, though, you use certain tried and true techniques on wildfires, in particular, dumping water from above. It is a tried and true method. You've got people on the ground making fire breaks. You've got fire retardants. In some cases, when the fires grow underground, it's even trickier. You have to use different equipment, but I would say the ones that I mentioned are kind of the main ones.
And Danielle, just a fantastic story here. Lots of really cool data. And what I'm noticing is just, there's some concerns here. There used to be discrete fire seasons, one for northern hemisphere, in the summer, and one for the southern hemisphere in our winter, their summer. But these are starting to kind of come together a little bit, and that's putting strain on these global resources. What's the solution there?
Well, I think the solution is not in place yet. So you're right. The way it has always worked in the past has been that most countries have their own fire seasons. They're reasonably predictable. In Canada, for example, where I am, we have pretty intense fires over the summer. They taper off in the fall, and by winter, usually we would have a dead zone in terms of fires. So in the case of sharing of resources, that has always been something countries have relied on. Canada and LA County have had an arrangement for 30 years, where in August we send a couple of our aerial planes that can dump water on fires down to LA County. They're usually there for 3 months. When we get into trouble, The U.S. sends their equipment back here. In 2023, Canada had massive fires. We got help from 12 countries that sent resources up here. And so there's been this global sharing. But what's happening now is the fire seasons are lengthening because climate change is creating conditions that mean more severe, longer fires. So you're getting fire seasons that extend into countries' autumns, that start earlier in the spring. In Canada, we have these zombie fires that are kind of a new thing, where the fires are so intense in the summer that they actually go underground and they continue to burn all winter long and then come up very early in the spring. So the worry is that if we all start to have overlap with our fire seasons, how do you share the resources? And sharing the resources has been a key part of dealing with fires. It means countries are going to have to start to have more fire resources on the ground, for one thing.
So is that people? Is it equipment? Is it helicopters? What is that? Or all of the above, maybe?
Yeah, it's all of the above. So I mentioned that Canada, sends these super scooper water bombers to LA. They were in the air yesterday fighting the Hughes fire. They're probably in the air again today, wind allowing. But we send, hoses, protective equipment, but people especially. Since 2000, so in the last 25 years, more than 9,000 firefighters have come across the border into Canada to help us fight our fires. We've sent about 4,400 abroad. It would be a more balanced trade sort of balance, if you like, if it hadn't been for 2023, because in 2023, Canada needed so much help. We brought in 5,500 firefighters from abroad. That was the year that the smoke blanketed New York. And a lot of those firefighters crossed the Canadian border from the United States.
And Danielle, in your story, I'm reading here, and again, I recommend this story to everybody on the Bloomberg terminal on Bloomberg.com. You focus in on a group of folks from Quebec, pilots and support staff, and their Super Scooper plane, and how important they've been to fighting the fires in LA. And you've got a great graphic in there. These fast aircraft carry up to 1,600 gallons of water. Each return to water in the Pacific Ocean more than 8 times in 1 hour. I mean, these guys are just going, they're incredibly busy. Do they make an impact here?
Well, I mean, sure, but it's an uphill climb, right? I spoke to one of these pilots who said that in ideal conditions, they can do one of those loops every 2 to 3 minutes, but a lot of things can complicate that. They have to have VFR, visual conditions. They have to be able to see where they're going. The winds can't be too high. In LA, there was, I think the first day that they flew, they had pretty good conditions, and they were able to do 23 drops of water, about 1,600 gallons a drop. So they're scooping up a lot. But there was another day they only did 4 drops because the ocean waves were just too high. So they couldn't actually get the water out of the ocean. It would have been too hard on the plane. They had to fly to a reservoir, which was further away to fill up. So there's a huge amount of variability. They have to worry about crews on the ground, right? When they dump the water, they have to make sure that they're not going to dump it on top of people who are building fire breaks and things like that. You could knock someone down. They can get closer in LA, which I thought was interesting. They're used to fighting fires in Canada, in Quebec, where the fear is when you dump the water, you could knock down a tree, which could then hit a firefighter. So they keep more of a distance between the water dumps and the people on the ground. In LA, because the vegetation is low, that's less of a concern, but they still have to be really careful.
All right, Danielle, really appreciate it. Danielle Bokov, definitely check it out. She's Bloomberg Green senior reporter on The Big Take. You can find it on the Bloomberg terminal, also Bloomberg.com/Big Take. Now, speaking of, we had initial jobless claims, the continuing claims rising to, I think it was like a 3-month high, but that's going to be distorted quite a lot by those LA wildfires. So Michael McKee is joining us, Bloomberg International Economics and Policy correspondent. Do we know how the LA fires have now affected the readings for jobless claims?
Well, we have a rough idea. The number for California jobless claims last week was up by 7,000, which doesn't seem like a lot. But the week before, which the fires were in that week as well, were up by 13,000. So you've got a number of people who have contributed to this slight rise we've seen in initial jobs claims. Slight, it's 223. Up from 217, and most states saw declines. Now, we're in the holiday distortion period as well, so it's hard to get a clear read on what all this means. You referenced the continuing claims up to 1,899,000. That's getting a little bit of a boost from the California fires because the people the 13,000 who filed 2 weeks ago are still on the rolls. But what that's kind of telling us is something also that we already knew, that companies, they may not be letting people go, but they're not hiring either.
We're going to hear from President Trump, virtual speech in Davos in just about a half an hour as per schedule. Are you expecting economic topics to be discussed there from the president?
Well, you know,
it is a World Economic Forum.
It is the World Economic Forum, but it is Donald Trump, so it's really hard to know exactly what he's going to say. But you can bet that the audience of CEOs is going to be sitting there anxiously awaiting to see if he might say something about tariffs. That's from what I can glean of the Davos coverage, that seems to be the number one concern of people in Davos. They're also looking for more talk about deregulation because they feel that's an important thing for them. And so those two would be the subjects I think would get the most attention from the audience.
What are you working on right now at your desk? So here's the thing with Mike. He'll sit at his desk and he'll tinker. He'll read the most random reports.
Yep.
Then he'll make all these tie-ins and link a nice thesis together. And then he'll send it to me and be like, look at this. And then we'll talk about it on email. What are you going to send me in like an hour?
Well, I've been putting together a couple of things today.
See? I knew it.
One, I'm looking at the overall change in auto imports from Canada and Mexico since the USMCA, the replacement for NAFTA, came in to being, which was July 1st in 2020. And you can see it's quite interesting. The trade balance between the countries, our trade deficit widened with Mexico and Canada, Mexico somewhat significantly. But at the same time, over that period, the trade balance with China shrank. So, you know, it's still too big for Donald Trump's liking, obviously, from what he says. But what we're seeing in terms of the cross-border Canada-Mexico stuff is that, you know, we're importing more things from them.
And is that the friend-shoring impact, do you think, a little bit?
A lot of that's the friend-shoring impact, and the fact that wages and costs are much lower in Mexico. So with a free trade agreement, it's been easy for companies, particularly auto companies, to move production to Mexico and then just import those cars because it doesn't cost them anything.
Also, oil. Our biggest importer of oil is Canada. Because they have heavy oil.
They import our oil.
Other way around.
Oh,
we import their oil.
Okay.
We still import a bunch of oil, and our biggest trading partner for that is Canada. So that's also a big one there.
That's going to be an interesting
Oh, I know.
question.
We'll talk about that later.
Whether the Canadians actually
do something about that. All right, Mike, thanks a lot. Mike McKee, Bloomberg International Economics and Policy Correspondent, on the nerdy things that he is looking at right now. All right, coming up, we're going to continue the conversation of different areas of the market under President Trump. We'll go to crypto next. Aisha Kiani is COO of MNNC Group. We'll get her take.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, the major averages mixed to little change. The S&P 500, 2 points lower, 6,083 right now. The Dow Jones Industrial Average up 85 points. The NASDAQ 100, 66 points lower. That's down about 0.3%. The stock story kind of revolves around the chip makers today. They are seeing a sell-off. This all started after SK Hynix's results that failed to excite the artificial intelligence bulls. And so as a result, you have shares of NVIDIA right now. They're down about 0.8%. Advanced Micro Devices, Broadcom, they're both slumping. American Airlines Group forecasting that surprise first quarter loss. A setback as the carrier tries to win back a lot of the corporate travel that it lost. General Electric exceeding Wall Street expectations. In fact, the best performing stock in the S&P 500. Best performing stock in the S&P 500, and it is up 6.5% right now. As we get ready to hear from President Donald Trump, maybe on tariffs, and as we get ready for the Fed, preparing to meet next week, Gennady Goldberg at TD Securities doesn't see Treasury yields going much higher from current levels.
Can we break out to 5? I think it's certainly not, implausible. But I think we're going to have trouble sustaining rates at substantially higher levels from here.
And right now, the 10-year is 3 basis points higher. That's at 4.64. The 2-year, that's pretty much unchanged at 4.30. And with interest rates higher than before the pandemic, Americans apparently are rolling over an ever larger portion of credit card debt. The share of cardholders making just minimum monthly payments rising to the highest in more than a decade. The typical credit card rates are close to the highest on record as well. That is above 21%. And get a better deal from the guy in the corner.
Exactly.
Anyway.
Can't let those things run.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney were live here in our Bloomberg Interactive Brokers studio. We are streaming live on YouTube as well, so head over to youtube.com, search Bloomberg Podcast Live, and that's the easy way to find us. Donald Trump, self-proclaimed greatest friend to the crypto space. Elon Musk in his inner circle. That's got to help. What does that mean for the crypto space over the next several years? Aisha Kiani joins us, Chief Operating Officer for MNNC Group. She joins us here in our Bloomberg Interactive Broker studio. Your community, the crypto community, are you enthused about having President Donald Trump back in the White House? Is it positive for the crypto world or not so much? Or is it too early to tell?
Too early to tell. So it's been both mixed signals. We obviously he's made the right moves with, a task force at SEC, with, the right CFTC chairman. Yes, all of those are, the right moves and the moves we've been anticipating. But what happened over the weekend was that Trump launched his own meme coin. And
wait, did I miss this? Okay.
Yeah, you missed it.
I missed it.
You missed it.
Okay.
Everyone missed it other than us, the industry folks. And we were basically like, what is happening? And then Melania launched a Trump coin on Sunday night.
Nice. What does that mean to launch a coin?
You just go on, so in this case, you go on Solana's blockchain and you launch a coin.
I'm going to launch a steel coin.
A steel? Yeah.
Yeah, why not?
Yes, I'm done.
Does it trade?
Yes, it does. It trades in crypto markets. It creates decentralized.
Does it have a value today?
I mean, combined, both of the coins had a combined value of 40 billion at a point.
40
billion with the B. 40 billion with the B. Yes.
Yeah. So help us understand.
I was watching football this weekend. I wasn't.
You were not focused on that.
Meme coin.
Yeah.
Okay.
But help us understand like the meme coin situation and all the froth versus the reality of crypto changing under Trump administration.
I would call meme coins the froth.
Right.
And that's a very bad look on us, and that's a very bad institutional look of the entire industry. That's something, we do not support. What, we're here to support is Bitcoin, ETH, Solana as like the real asset, so the real tech. But if you're just going to go launch a coin, so I wanted to mention the stats here today because Chain Analysis just ran the research report yesterday. So 50% of Trump and Melania holders had never bought a Solana altcoin before. 47% of buyers created their wallets the same day they purchased the tokens. And then 83% of the holders own sub $1,000 of Solana assets. So he onboarded this many people on Solana's blockchain for the ecosystem.
So is that, I mean, and the suggestion is these, for lack of a better word, investors don't really, we have no idea to know who they are, or maybe how educated they are.
Exactly,
and
right? Like what's the value? What's the intrinsic value, right?
Yeah.
If you're going to invest in Bitcoin or ETH or Solana or Avalanche, there's an intrinsic value to it. It's a trusted blockchain. But what's an intrinsic value to a meme coin?
Okay.
I mean, I don't know. I think that's probably the point, right? So what are you guys talking about in class? Also, you don't you teach at NYU?
I teach,
you teach
yeah,
NYU, right?
Yeah.
What are you guys talking about when it relates to crypto and regulation? What's like the zeitgeist there?
So I mean, obviously, all positive news for us.
Okay.
You know, going forward, starting this administration, that's what we're looking forward to. Like, you know, is this a commodity? Are all of them are commodities? Are all of them are utilities? Or are we just going to give this a new class, you know, share class or a new asset class? That's one thing. The other thing is that obviously on how the tech works. So something that this meme coin craze over the weekend did was it kind of pointed out faults in our own space, right? Like Coinbase, the largest retail institutional exchange, had issues. Solana, the blockchain itself, had issues, right? Are we ready? Are we ready to onboard this many users? So I would be opening up my semester with that. Normally I do it with Bitcoin, but this time I would say, guys, this is the perfect use case, right? Does it work? Does it not work? Which case worked? Which case didn't work? And we can analyze it chain by chain, what broke at what point.
What is the expectation of the industry about regulation under a Trump administration? Is this something that you expect the SEC to take the lead, the CFTC, something new?
So he has set up a special task force at SEC, and Caroline Pham, the acting chair at CFTC, is also very pro-crypto. I've known her for a while, you know, phenomenal person. It's just that they have a better understanding of the asset.
Mm-hmm.
So when we'd go, you know, for guidelines, or when we'd go to help, or when we'd ask for more clarity, they know what we're talking about, other than, you know, just being an onshore asset or an offshore asset.
So it's less like open season for crypto, and it's more just like the people in the positions have the right kind of language to sort of move things along in a helpful way.
That's
maybe.
correct.
Or does someone understands like the words you're saying if you're talking about crypto?
Right.
So based on that, what's realistic in this administration, and what is the stuff that we should be ignoring, like the strategic reserve kind of thing? Like what's real, what's not?
I think anything that touches Bitcoin and anything touches Ethereum or anything that touches any of the original legacy coins is real, right? Bitcoin Reserve, yes, that should be, you know, real, because Bitcoin does have a limited supply. But like launches of meme coins to generate like, you know, additional wealth under World Liberty Financial, that is considered froth.
Okay, so the strategic reserve, Alex is familiar with this, for oil, you think it has some value that should be considered for Bitcoin?
Yeah, I think it does. Because again, limited value, limited number, limited quantity, only 21 million in value, 21 million in quantity, 19 million and change have already been mined. So, and oil, you can still keep on drilling, right? Like you'd find oil at like, you know, unknown places still. But Bitcoin, we cannot go back and change the code to make it from 21 million to 25.
All right. I mean, fair enough.
Yeah.
Aisha, thanks very much. It was so good to get your perspective. We love having you on. Aisha Kiani, Chief Operating Officer at MNNC Group and professor at NYU. What's your class called?
Introduction to Blockchain and DLT.
Don't you feel like we should take that class?
Yeah. Can we come down and audit? Can we come down and audit it?
I mean, kind of, right?
I'll send you my lectures, and the more he like keeps on making these announcements, I feel like the more I'll be coming here. So I'll start just sending you my lectures.
Okay, we'll take it.
Yeah.
All right, well, coming up, we're going to talk about one airline that has not benefited from the boost in international travel. American Airlines seeing a surprise loss. We're going to break down why, what happened. George Ferguson Ferguson, Bloomberg Intelligence, will be joining us next. This is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you can easily find us here. We had coming up until today, some really good numbers coming out of the airlines. Demand really strong here. Then we got American Airlines today. Surprise loss in the quarter. Now, it's kind of a real surprise, I think, to investors and stocks trading off pretty heavily today. So we want to figure out what's going on with American Airlines and then see what else we need to know about the airline and aerospace business. We do that with George Ferguson. He covers the airlines, the aerospace industries for Bloomberg Intelligence. George, let's start with American Airlines. A little bit of surprise for the market seeing the loss coming out of American. What happened?
Yeah, so I mean, on an adjusted basis, though, American looked fine in 4Q. It was all about their 1Q guide, and that was guided at a loss compared to their peers, United and Delta. So, I mean, American looks like they're just going to add less capacity in the first quarter, and that's going to make it more difficult to manage expenses. Expenses will be higher than peers, and so their performance just won't be as good. But I guess what I would say, though, is American's 4Q earnings, their revenue growth in all markets looked better than their peers, on par or better. So American, a couple of years ago, decided on a new strategy where they were going to try to do less agency ticketing, through travel agencies and such, and more direct. That kind of backfired. They've turned that around, and they're going back towards a more traditional distribution of tickets. And I think it's starting to show up in the